Hello students, welcome to the marathon session of Strategic Performance Management, that is our 50% syllabus of paper number 20A, that is SPMBV, that is Strategic Performance Management and Business Valuation. So paper 20A and 50% portion of paper 20A is SPM, and for 50 marks you just have to study only 4 chapters of SPM, only 4 chapters. With very less efforts you can score more, at least in this paper, in paper number 20A SPMBV. And after this marathon session you will feel very confident for your examination. This is my guarantee. In this marathon session we are going to cover all the examination questions, all the important concepts, and after this session you will be able to score very well in your exams. Okay, so in this session we are going to cover all the 4 chapters in this marathon, all the 4 chapters of SPM, and after this you will be getting a marathon session for business valuation also, which also carries the weightage of 50 marks in paper number 20A. So this session is particularly about SPM. Okay, before starting the session I must tell you one thing. Just wait for a second. Yes, I want to tell you that initially I want to tell you the paper pattern. See, as you know, in any paper of CMA final, any paper, I mean every paper is for 100 marks, right? In this 100 marks, you have 2 sections, section A and section B. Okay, you have 2 sections, section A and section B. So, you know section A will be objective for 30 marks and section B will be subjective for 70 marks, right? So in this paper, in Strategic Performance Management and Business Valuation, our paper number 28, I am going to tell you the weightage of each question for SPM and how many questions will be there. So as you know, in total there are 7 questions in the paper in section B. In section B, subjective part, there will be 7 questions, okay? And out of this 7 questions, you have to attempt 5 questions of your own choice. You have to attempt 5 questions of 14 marks each. Okay, so the paper pattern is fixed. The paper pattern is fixed. And see, question number 2, question number 3, and question number 4. The initial 3 questions of subjective part will be for SPM. And the rest 4 questions will be for BV part, business valuation. Okay, so 3 questions will be there for SPM part, and in each question there are 2 sub questions. Like for in question A, question 2 there will be question 2A and question 2B. In question 3 also there will be 3A and 3B. In question 4, 4A, 4B, like that. So every question for 7 marks, and in total one question as whole carries the weightage of 14 marks. Okay, so it is fixed. It is fixed that in question 2A, in question 2, you will get to see the theory of SPM. It will be from chapter 1 or chapter 2. It could be from any chapter. Sometimes they ask from chapter 1 only, both the questions, and sometimes they ask from question 2, and sometimes they give one question from chapter 1 and one question from chapter 2. It is fixed. Okay. Question 3. Question 3A will be practical and question 3B will be theoretical. This one will be from chapter 3. It is 100% fixed. And 3B will be theory portion of chapter 4. And in question 4, they will be asking you practical. 2 questions of 7 marks each. Okay. So question 4 will be practical. So you can see that the weightage of theory and weightage of practical is equal. There are 3 questions of 7 marks each for theory and 3 questions of 7 marks each for practical. So this weightage is fixed. This weightage is fixed. So initial 3 questions will be from SPM and you have to try to score as much as in SPM. You have to score as much as possible in SPM because SPM part is much easier. Okay. And after this marathon, I am sure you will be able to score really very well in your exams. So SPM is a blend of theory as well as practical. Okay. And the weightage of theory and practical is equal. But the good news is, for practical portion, you don't have to put so many efforts because there are very less topics, and if you are studying all the practical topics, you will surely get 21 marks. That is 3 questions of 7 marks each. You can surely score 21 marks. But theory portion is comparatively larger than practical portion, but it's okay. It is also scoring. Okay, so this was the paper pattern for SPM, and in MCQ also they will be asking you 7 to 8 questions of SPM for 2 marks each. So it will be for 15 to 16 marks in MCQ also. Okay, not 15 to 16, 14 or 16 marks. So it was about the paper pattern. Now we are going to start our chapter number 1. Chapter number 1. Introduction to Strategic Performance Management. So basically this chapter is the fundamental of this subject. In this chapter, we will get to know that what is the meaning, why we are studying this subject, what is the meaning of the term performance management. So this chapter is the introduction part of this whole subject, SPM. So in this chapter, we will get to know that what is strategic performance management, what are the objectives of performance management, and everything related to the base of this subject. Okay. So without any delay, let's start with chapter number 1. See, in the notes, all the important topics and all the important questions which are being repeatedly asked in your exams has been given. Okay, so you have to master all these questions and you will get the notes in our Telegram channel. And if you have any queries, if you have any of the doubts, you can ask in Telegram group. Okay, link is given in the description. Okay, so let's come the question number 1. Discuss the concept of performance management. State its features, objectives, and elements. So, what is performance management? What do you mean by performance management? What is the concept of performance management? See, performance management is to assess the performance of any organization. Assess the performance of whom? The employees, the management, the organization as a whole, to assess the performance. As the title suggests, performance management, managing the performance in any organization is performance management. Okay, finding ways and using techniques to measure the performance is performance management. This subject is about performance management, how to assess the performance, finding new ways and using the techniques to measure the performance in any organization is SPM, Strategic Performance Management. Okay, performance of organization as a whole. If we are able to get the desired results or not, if everyone is performing well or not, if the performance is up to the point or not, we are able to get the desired results or not. Okay, so let's come to the definition part of performance management. So performance management is a continuous process It is a continuous process. Continuous process. What do you mean by continuous process? That means it is a never ending process. Once it is started, it never ends. Once it has been started, it never ends. So it is a continuous process, not a one time process, but a continuous process. Of what? Of identifying. Identifying means to see what needs to be done, to decide what needs to be done, what we need to achieve, what are our goals, to identify, measure. Now what is the meaning of measuring? If we are able to get the desired results or not. Then developing performance in organizations, that means where we are standing to moving to the higher level. Moving to the higher level, that means growth. It is growth. So identifying, measuring, developing performance in the organization, moving to the higher level than the previous level, and linking each individual's performance and objectives to the organization overall mission and goals. See, this point is very, very important. Linking each individual's performance and objectives to the organization's overall mission and goals. That means, first of all, tell me one thing. What if the goals of the organization, what if the goals of the organization and the goals of employees are different? What will happen? Tell me, what will happen if the organization's goal and the individual goals, that means the goals and objectives of employees, are different? What will happen? What will happen? The answer is very simple. The organization will not be able to achieve its goals and objectives, right? Because how a organization achieve its objectives and goals? Through the employees. Employees are the main factor which help the organization, to reach to the level it wants to achieve its goals, right? Without human resource, is it possible to achieve the goals? No, right? So it is very important that the individual's objectives and organization's objectives should be same. Otherwise, the organization would never achieve its goals, right? So the individual objectives and the organization objectives should be same. So performance management ensures that the individuals are having same objective as the organization, because if the organization is able to achieve its goals and objectives, automatically the employees will be happy and they will also achieve their objectives, right? So linking each individual's performance and objectives to the organization overall mission and goals. This was the highlighting part of this definition. So I hope the definition part is clear. Performance management is a continuous process of identifying, measuring, developing performance and linking individual objectives with the organization's overall mission and goals. Now see, features. You will see in the features part, 2 points are given, and these 2 points are the highlight of definition of performance management. As I told you, the first thing is it's a continuous process, that means it's a never ending process, and the second one is linked to the strategic goals. That means individual's performance and objective is linked to the organization's overall mission and goals. In short, it means that everyone is moving in the same direction to achieve the organization of objective of the organization. Is it clear, the definition part? Now the objectives of performance management. Objectives of performance management. I hope the definition part is clear. Now moving to the objectives. So what is the first one? When performance management is linked to the compensation package of the employee, it motivates the employee in attaining their goal. Very simple. If the performance of any employee is linked with salary, bonus, promotion, incentives, then automatically he will feel motivated to perform to his best, right? So performance management is linked with the compensation package. If you are performing well, you will be given incentives and bonus and hike in salary and so many other things. So this is motivation. This is a concept of motivation. Then employees are able to identify proper knowledge and skills required for performing the task. In performance management, it is being told to the employees in which direction they need to move, what they need to do for their job. So it becomes very clear to the employee that what he needs to do. So if he is identifying what skills are needed for his job, then he will perform well for his task and the skills will also improve. Then the third point, performance management assists the implementation of an effective reward system, the feedback and coaching. Performance management assists the implementation of an effective reward system. In performance management, if the employees are performing really very well, they are being rewarded in front of everyone. So there is effective reward mechanism which motivates the employees to perform their best. Then feedback and coaching mechanism provides a two-way communication system between the supervisors and the employees. See, in the concept of performance management, the supervisors give feedback to the employees and employees can also give the feedback to the supervisors. So it's a two-way communication system which motivates the employees because they feel very happy and valued when they can also give the feedback to the supervisors when they participate in the organization and they are welcomed there. So performance management is a concept which includes the supervisors, the management as well as the employees equally. Then performance management creates an environment where the strategic purpose of the organization is suitably perpetuated throughout the organization. So it ensures that everyone is working in the same direction so that the organization's objectives are fulfilled. It is able to achieve the objectives. Then performance management aids personal growth and advancement of the employee as they are acquainted with the desired knowledge and skills for particular job which is also aligned to the strategic purpose of the organization. So what it is saying, through performance management, employees improve their skills. They improve themselves continuously in order to perform their task and perform their job, and they also advance in their career. Okay, they are being trained for it. They are being trained for their job and they advance in their career while staying aligned with the organization's goal. So these were the objectives of the performance management. So there is growth for employees and attainment of objectives of the organization. So it is beneficial for employees also, individuals also, and for the organization also. That's why this concept was introduced of performance management. The concept of performance management is for motivating the employees so that they can perform to their best level. Is it clear? The objectives of performance management? Now let's come to the elements of performance management. In order to get better insight into the nature of performance management, the elements of same needs to be discussed. So what are the elements of performance management? The first one is setting up of objectives, which is the starting point. It is the starting point, setting of objectives. It is a starting point where clear objectives are given to the employees. They are told the objectives of the organization and clear objectives give direction to the employees. Now they know in which direction they need to move. Then measuring of performance. After the goals are set, managers must measure how the employees are performing, if they are performing well or not. And measurement should be based on facts, not on the opinions. Measurement should be based on facts only, not on the opinions of the supervisors and the management. It should be based on how well the employee is working. So this is measuring the performance. the supervisors see that whether the targets given to the employees are met or not, deadline met or not, targets achieved or not, what is the quality of work of the employees. Then feedback mechanism. As I told you, there is a feedback mechanism present in performance management in which the employees and supervisors both can give feedback to each other. And feedback should always be constructive. That means suggestion plus praising. Suggestions plus praising. If something is not good, then give suggestions, and if something is very good, then praise them. Then reward system is also there. Reward system based on performance outcomes. If the employee is performing really very well, then he or she will be rewarded. Then amendment of objectives and activities. That means sometimes what happens, whatever we have planned, everything does not works as per the plan. Then if change is required according to the environment, the external environment, or if something happens in the internal environment, if change is needed in the organization, then the objectives should be amended. It should be flexible, and the employees should also be told about it. The employees should be informed about it, what they need to do. For example, a company was selling goods physically before COVID. Now COVID came, then they started selling goods online also. So if something changed in the external environment, if something is not working, then objectives needs to be amended. Objectives needs to be amended to achieve the goals of the organization. Is it clear? Is it clear to you all? I hope the concept of performance management is clear. Features, objectives, element is everything is clear to you. I hope it is clear to you. Now differentiate between performance management and performance appraisal. So there are two similar concepts, performance management and performance appraisal. Both are similar concepts, but still they are very different. They are similar but not same. These are two different concepts, performance management and performance appraisal. So now you know the concept of performance management. Now you know the concept of performance management, that is measuring the performance of employees, motivating them, giving them feedback, reward, and everything. Now what is performance appraisal? It is a similar concept, but it is not same. It is different from performance management. So what is performance appraisal? It's just like a report card, a formal report card, formal evaluation of the employee at the end of a particular period. It could be 1 year, 6 months, anything. So evaluating the performance of the employee and giving him the rating, giving the ratings to the employees. So in performance appraisal, rating is being given to the employees, and manager judge the employee. Managers and supervisors judge the employees on the basis of their performance. So it's just a part of performance management, but it is different from performance management. Okay, now let's see the difference of performance management and performance appraisal. Now the first point is focus. What is the focus of performance management? It focuses on values, behavior, everything. It focuses on values of the employees, behavior of the employees, objectives are fulfilled or not, everything. If the performance is good or not. So it focuses on everything, values, behaviors, objectives, everything. But what about performance appraisal? It just focuses on qualified objectives. It just focuses on the performance of the employees. It doesn't cares about the ethics and all. And then ownership. Performance management is owned by the line managers. That means immediate seniors, immediate managers of the employees. And performance appraisal, generally the ownership is in the hands of HR manager. HR manager performs the performance appraisal. Then ratings. There is no rating system in performance management, whereas in performance appraisal, the employees are being rated on the basis of their performance in regular intervals. Then process. The process is very flexible in performance management. That means it can adapt to the changing environment, market conditions, and employees' development needs. It could be changed, but it is fixed in performance appraisal. That means it usually happens in the intervals with structured forms, and there are fixed parameters on the basis of which the employees will be judged. So the parameters are fixed. Approach. It is joint approach. Performance management is joint approach. That means both the supervisors, managers, and employees both can participate. Both participate equally. But it is top-down approach in performance appraisal. That means the top level management has the power in the hands. They rate the employees. Then review. It is continuous review system in performance management. The performance is continuously reviewed, but it is fixed. Annual appraisal meeting. It is fixed in fixed intervals. The employees are being rated. Their performance is being rated in fixed intervals. In the case of performance appraisal, then paperwork. There is less paperwork and more communication in performance management, whereas in performance appraisal what happens, there is too much paperwork. There is too much paperwork. In the case of what, performance appraisal, there are fixed forms, there are detailed and fixed forms, rating is being given, rating forms are also given, rating sheets are there, and written feedback is given to the employees. Written feedback is prepared and given to the employees. So this was the concept of performance appraisal. This was the concept of performance appraisal. I hope it is clear to you. See what is given here. Performance management focuses mainly on the achievement of results. Okay. However, performance appraisal is concerned with overall development of human resource and ensuring that they contribute to their best. If the employees are being rated, they have a fear of judgment, right? So they perform their best of their abilities towards fulfillment of organization's objective. So this was the concept of performance management as well as performance appraisal. I'm going to give you one example and it will be very clear to you all the difference between these two concepts. Still, if you are not understanding, it will be very clear with this example. For example, you are going to a gym. Okay, you are going to a gym. So there is a trainer. He regularly checks on your performance. He tells you about the forms. He corrects your forms and postures. Okay. He regularly checks your performance, workouts, corrects everything. He's giving you diet plan and all. So this is performance management. He's giving you feedback and all. So he is training you basically. But after 2 to 3 months, regularly after 2 to 3 months, he checks your weight. This is performance appraisal. And then he gives you feedback about your performance in the fixed interval of time, suppose 3 months. So in performance management, he is continuously training you. On the other hand, in every 3 months, he is checking your performance. He is judging you. He is giving you rating. He is telling you if you are doing good enough or not, if you are able to lose your weight or not. So this is performance appraisal. Okay. So in performance management, there is it is a continuous and flexible process with communication, feedback, training, and guidance. So at 3 months, every 3 months, he checks your weight. Is there is muscle gain or not, weight loss or not, and he gives you a final report. So it's a one-time evaluation, that is performance appraisal. So I hope after this example, it is very clear to you the difference in the concept of performance appraisal as well as performance management. Now let's come to performance measurement tools. What are the two tools for measuring performance? Productivity and efficiency. Productivity and efficiency. So what is productivity? Productivity is output divided by input. Output divided by input. That means how much output can be produced with the given input. How much output an employee is producing through the given amount of input. For example, in 5 hours, employee A is producing 10 units of products. In 5 hours, one employee is producing 10 units of products and the other employee B, is producing 15 units of that product. Same product, everything same. Input is also same. Input, what is the input here? Time. 5 hours is given to both the employees. One is producing 10 units and one is producing 15 units. So, if we are dividing output with input, that is 10 divided by 5 in case A and 15 divided by 5 in case B. So which one is more productive? Here the answer will be 2, here the answer will be 3. Obviously, the employee B is more productive. Employee B is more productive, right? So this is productivity. How much an employee is producing, how much output an employee is producing through given amount of input. Then the next concept is efficiency. Next concept is efficiency. What is the meaning of efficiency? What is the meaning of efficiency? How well we are using the input. How well we are using the input. For example, employee A is given 2 kgs of input, 2 kgs of input, and he is able to produce 10 units out of it. 2 kgs of input is given to employee A and he is producing 10 units. Employee B is also given 2 kgs and he is producing 20 units. So with the same input, both the employees are producing different amount of output, right? So efficiency is about how well we are using the input to produce the output. So which employee is more efficient? Obviously this one, because he is producing more. But one thing, quality should not be compromised. Quality should not be compromised to produce more. Input is equal but the output is more in the case of employee B, so he is more efficient. So productivity focuses on quantity but efficiency focuses on quality. How well we are using the input to generate the output without compromising in the quality. So there is no wastage of the inputs, no wastage of the resources. So this was the difference of productivity and efficiency. Both the tools are very important if we need to measure the performance of any employee. Okay, so this concept was not so important. You can read it. You can read the concept by your own. I have explained you the crux of both the terms. Now, tools for financial performance analysis. Tools for financial performance analysis. So if you remember, we have studied it in detail, the tools for financial performance analysis. Tools for financial performance analysis, in which we have studied the 5 tools. What were those 5 tools? The first one was comparative statements, then common size statements, trend analysis, ratio analysis, and cash flow statements, right? So we have studied the 5 tools, and usually practical part is being asked from these concepts. This topic, practical part, is being asked from this topic only. If they have to ask you any question, any practical question from chapter 1, they are going to ask it from this topic only. So prepare. The first question is about prepare comparative balance sheet and study its financial position. So what we have to do, we have to prepare comparative balance sheet. Data for 2 years is being given here, and we have to prepare the comparative balance sheet. And then we have to comment on the financial position. It is given here, study its financial position. That means we need to comment on whatever we have observed. So it is very simple. What we need to do here, balance sheet is given in the question. Balance sheet is given and data for 2 years is given. In comparative balance sheet, we compare the performance of 2 or more years, right? So we need to compare the performance of 2 years, how much decrease and increase is there in assets and liabilities. And if income statement, then the elements of income statement. So this is comparative balance sheet. What we need to do, we need to see the change in each and every element. Suppose cash and bank balance. So in previous year it was 23,600 rupees. Now it is only 2,000 rupees. So there is decrease, right? There is decrease. Decrease of how much? 21,600. So we need to find out the percentage. We need to find out the percentage of each and every element's increase or decrease. So you can see here, it was 23,600 in previous year. Now it is only 2,000. So it is being decreased by 21,600. And how to find out the percentage? How you will be finding out the percentage? It will be 23,600 minus 2,000 divided by previous year figure. Previous year figure, that is 23,600. The previous year figure. So it will be 21,600 divided by 23,600. This is negative. So the answer will be approximately 91.5%. So the cash is decreased by 91.5% in the current year. Is it clear to you all? We just have to find out the percentage of increase and decrease in the assets and liabilities. Likewise, you have to solve the whole question. We are comparing the performance, our own performance with previous years. This is the crux of comparative balance sheet and income statement. So the whole process you have to do, same you have to do for debtors, inventory, current assets, everything you have to do the same thing. You have to repeat the same process. So it is a very easy concept. Then you have to write in the answer your analysis, what you have observed in the whole scenario. What you have observed in the whole scenario. For example, you are observing that there is decrease of 33.9% in current assets. You have to write this. Then current liabilities also decreased. So if current assets are decreasing plus current liabilities are also decreasing, you can say that, you can assume that the current liabilities have been paid using the current assets. So it is a good thing because liability has fallen more. The percentage of decrease in liability is more than decrease in assets. So these kind of observations you have to write. These kind of observations you have to write. You can also write about the cash. Cash is declined by 91.5%. This is an adverse cash position for the company. Whatever you are observing, you have to write in the answer. You have to give the analysis, because in the question it is mentioned that study its financial position. If these kind of words are written in the question, you have to comment on the financial position. So it depends on you what you are observing and what you are writing in the answer sheet. But 2 to 3 most important things are there. Like if balance sheet is given, write about the assets, write about the current assets, current liabilities, cash, then long-term liabilities, debt structure, capital structure. You can write these things. Focus on cash, current assets and current liabilities more. Then question number 5. From the following income statement, illustrate a common size statement and also interpret the results. Again, in this question, what is given? You have to prepare the income statement. You have to prepare the income statement, common size income statement, and also interpret the results. Interpret the results. That means you have to write your observations. So what is a common size statement? In common size statement, we have to express each item as a percentage of a common base. We have to express each item as a percentage of common base. And I have told you that when common size statement is given, if income statement is given, you have to take sales, you have to take turnover as base. That means this net sales. And when balance sheet is given, you have to take total assets or total liabilities, any one thing, because total assets is equals to total liabilities in any balance sheet. So you have to take total assets or total liabilities, any one, as base. Okay, so here it is asked about income statement, so we are going to take this sales as base. So we need to express each item as a percentage of a common base. That means, see, if we need to find out in sales how much percentage is for cost, how we are going to do that? Simply we are going to divide this 5,70,000 divided by the sales 10,50,000 into 100. So it will be 54.29 percentage. It will be 54.29 percentage. Again, same thing for gross profit. 4,80,000 is our gross profit. 4,80,000 divided by 10,50,000 into 100. So we are converting each item as a percentage of common base. What is the common base? Which is common denominator. That is 10,50,000, the sales, amount of sales. This is how we are finding out the percentage, the weightage of each and every element in the base, that is sales. So we can say that cost of goods sold is 54.29% of sales. Gross profit is 45.71% of sales. So it becomes very easy to compare things. If we are going to compare the figures only, see, if you are going to compare figures, like you are comparing 2 years, the data of 2 years, in one year the profit was 4,80,000, in another year the profit was 7,05,000. So you will say that profit in year 2024 is more. You are going to say like that only. But it is not always correct. It is not always correct. We cannot directly compare the figures. We have to compare the percentage. Sometimes what happens, the figure may be larger in 1 year, but you will find out the percentage of sales, it will be less. Sometimes it happens like that. So it is better to compare the percentage of what? Percentage of sales, if income statement is given. So you have to do similarly for both the years. For all the items, you have to convert all the items as percentage of a common base. Then you have to compare the performance of 2 years. Here the data is given for 2 years. It can be given for 2 entities also, 2 different entities also. Again, you have to observe and write the observation on your own. If income statement is given, focus on sales, focus on profit, focus on operating expenses and profit after tax. So sales, profit, cost, operating expenses, observe these things and write your answer. Then next question is for ratio analysis. Next question is for ratio analysis. Mostly question is asked from these three concepts only in chapter 1, mostly. Now question 6 is about ratio analysis. See, balance sheet for 2 years is given here. Balance sheet for 2 years is given. What we need to do? We need to find out the ratios which are asked in the question. If you need the formula sheet for ratios, you can message in the Telegram group also. If you need formulas for ratios, please tell us in the Telegram group. See, calculate the following ratios and comment on the financial position. Again, we need to calculate the ratios and then we have to comment on the financial position. That means we have to write the analysis. So the first one is return on capital employed. Return on capital employed. So you know the formula for return on capital employed. It is profit before interest and tax, that is EBIT or PBIT. EBIT or PBIT, you can say anything. EBIT divided by the capital employed. That means how much return we are generating on the capital employed. How much return we are generating in the capital employed. So EBIT divided by the capital employed. So simply what we need to do? We have profit after tax. We have profit after tax and interest here. See this one, 34 and 26. Sorry, wait for a second. We have profit before tax, so we are going to take this. We are going to take this 54. This is profit before tax. Instead of taking this and adding back the profit, we are taking profit before tax and then we are going to add the interest, that is 54 plus 4. EBIT divided by the capital employed. So what will be the capital employed? Capital employed means this capital and reserves portion whole, this total of capital and reserves plus long-term debt. Long-term debt is also the part of capital employed. Always remember, long-term debt is the part of capital employed. And if you are not taking debt in capital employed, you have to write your assumption. But please take long-term debt as a part of capital employed. So we are going to add 236 plus 80. 236 plus 80. So the answer will be 18.4%. It will be 18.4%. Same thing you have to do for this previous year also. Same thing you have to do. So we will be getting our capital employed. And one more alternative solution is given. See what is given here. You can, in the alternative solution, this revaluation reserve is deducted from capital and reserves. Why? Because revaluation reserve is not an actual reserve. We are not getting any cash in our hand. It is due to fluctuation in the assets, fluctuation in the value of fixed assets, right? So It's just in books. We are not getting any excess cash, extra cash in our hands. So it is correct that if we are not considering this revaluation reserve as a part of capital and reserves. So you can do one more thing here. You can, in the alternative solution here, you can deduct the revaluation reserve. 236 minus 20 plus long term debt. That approach is also correct. Okay. Then the next one is asset turnover ratio. Assets turnover ratio. So the formula is turnover divided by total assets. How much turnover we are generating through each 1 rupee of asset. So turnover divided by assets. What is the turnover given in the question? 418 divided by total assets. That is 408. 418 divided by 408. It will be 1.02 times. Same thing you have to do for this year also. Then current ratio. Easiest one. Current assets divided by current liabilities. Current assets divided by current liabilities. So what are the current assets given? Current assets. The total of current assets is 148 divided by current liabilities. Current liabilities is 92. So 148 divided by 92. This 148 divided by 92. Same thing for the other year also. Then inventory turnover ratio. Inventory turnover ratio. So what is the formula for inventory turnover ratio? COGS, cost of goods sold divided by average inventory. So what is average inventory? Opening stock plus closing stock divided by 2. This is average inventory. So cost of goods sold divided by opening stock plus closing stock divided by 2. So in the question, cost is also given. For finding the cost of goods sold, what you have to do? The formula for cost of goods sold is opening inventory plus purchase minus closing inventory. Or simply you can do one more thing, sales minus GP. Sales minus GP. I hope you know the formula of cost of goods sold. It is very basic one. So first we have to find out COGS, cost of goods sold, divided by average inventory, that is opening inventory 74 and closing inventory 84. 74 plus 84 divided by 2. See, 74 plus 84 into 0.5 or divided by 2. Same thing it is. So you have to find out inventory turnover ratio by dividing cost of goods sold with average inventory. I hope it is clear to you all. I am not solving each and every point because these things are very basic and very easy. Once you know the formula, you can do it by yourself. Then equity gearing ratio. Equity gearing ratio. It tells that how much interest bearing securities are present in our share capital. That is preference share capital and loans. Preference share capital and loans divided by ordinary share capital and reserves. That means equity share capital and reserves. So what you need to do? You have to take preference shares. How much it is given? 50,000 for preference share it is given, and for loan long term debt how much it is given? 80. 50 plus 80 divided by the equity part in the capital structure. That means 236 minus 50. This. We don't have to take preference share in the denominator. We have to take preference share capital in the numerator because it's a, for this we have to pay a fixed dividend, right? So interest bearing securities and dividend bearing securities are in the numerator divided by the ordinary share capital, that means equity plus reserves. So 50 plus 80, 50 for preference share, 80 for debt, divided by capital, whole capital minus preference share. Is it clear to you all? Then the next one is dividend coverage ratio. Dividend coverage ratio, that means profit after tax and preference dividend. How much profit is remaining after paying the preference dividend and tax, what we have now in our hands, divided by dividend paid. So basically we are finding out the cover, the dividend cover. How much profit now we have available now? How much profit we have now in our hands after paying the dividend? So we have to find how much times profit still is in our hand after paying the dividend. It is called the dividend cover. So profit after tax and preference dividend, we have to take here profit after tax, this is 34, minus preference dividend, this profit after tax and preference dividend, divided by dividend paid, that is 12. That is 12. Here we have to take equity dividend. Okay, equity dividend, not preference dividend. After paying the preference dividend, that is outside liabilities, after paying the outside liabilities and tax also, how much is available in our hand after paying the equity dividend also, how much profit is in our hands in comparison with equity dividend. Then the last one is price to earning ratio, the easiest one. MPS divided by EPS. To find out the EPS, what we have to do, we have to take profit after tax, which is available for equity shareholders, divided by number of equity shares, it will be EPS, right? Then MPS divided by EPS. MPS is already given in the question. EPS you have to find out by dividing the profit with number of equity shares. Okay, and in each and every point you have to comment. You have to comment if it is decreasing, if any ratio is decreasing or increasing, and what could be the possible reasons according to you. So you need to comment on that also. So these were the questions. These were exam questions only, and similar questions you have to do for your exam as well. Mostly questions, practical questions comes from this part only, tools for financial performance analysis. Please do it carefully, all the topics of tools for financial performance analysis. I hope it is clear to you all. If you need the formula sheet for ratio analysis, you can ask in the Telegram channel. Link is given in the description. Now let's move to the next topic, that is supply chain management. So what is supply chain management? We have to answer what is supply chain management and what are its components. So what is the meaning of supply chain management? Basically, supply chain management includes all the activities which start from procurement of raw material to delivering the finished goods to the customers. Supply chain management is the management of flow of goods and services and includes all the process that transform raw material into the final products. That means all the activities between procuring the raw material for manufacturing to producing and delivering the finished goods to the customers. So it is the entire flow of goods and services. It includes everything. Sourcing. The first thing is sourcing. That means from where we are going to buy the material. Then procurement. That means procurement, purchasing of raw material. Conversion, converting the raw material into finished goods. And then logistics management. What is logistics management? That means every activity which is performed to deliver the products. Planning and controlling the movement of goods, that means transportation, warehousing, simply delivering the goods to the customers. Initially to the manufacturers, to the wholesalers, to the retailers, and then to the customers. So it includes all the activities, whether it is sourcing, whether it is procurement, conversion, logistics management, transportation, warehousing, everything. It includes coordination and collaboration with the channel partners, suppliers, intermediaries, third parties, service provider, and customers. Everyone is having coordination among them. Each and every partner, each and every element of the supply chain management is having coordination among themselves. Is it clear to you? Basically, everything which is done to produce, to manufacture, and to supply the goods, the finished goods to the final consumers. This is supply chain management. Then what are the components? What are the components of supply chain management? The first one is production. First one is production. The first component is production. That means production is the base of the supply chain. Without producing, how can you sell? So it is the base of supply chain. That means making goods as per the market demand, and it requires proper planning as well as resources. Producing as per the requirements of the market is the primary requirement of supply chain management. It needs immaculate planning. Master production schedules have to be placed which takes into account plant capacities, working load balance, quality control, and equipment maintenance scheduling. Everything is planned and resources are also used. Proper planning and resources are required. Then the second thing is inventory. Second component is inventory. That means deciding how much stock is to be kept at each stage. How much stock we have to keep, how much stock an organization needs to keep, so that there is no shortage as well as there is no excess stock lying idly. Then location. Deciding the location of manufacturing as well as warehouses. Deciding the location where the goods will be produced and where it will be stored. Deciding the location is very important. Then, and one more thing, it is very important to choose the right place for production. It is very important so that the cost will be efficient. To reduce the cost, it is very important to decide the correct place for producing as well as correct place for warehousing. Warehouses should be near the customers, so the transportation cost will decrease. Then transportation. Again, it is a very important component. Selecting the right mode of transportation is very important to reduce the cost. Okay. Then information. There should be a smooth flow of information because information is the backbone of supply chain management. It helps the managers to decide that what needs to be produced, what are the customers' expectations, what they are demanding. Okay, what to produce and whom to sell, where to store and how to transport. Everything is dependent on the information. Information is the backbone of supply chain management. So these were the components of supply chain management. Components of supply chain management. Now the next question is, explain the 4 intrinsic flows. There are so many flows in the supply chain management. So what are the intrinsic flows of supply chain management? Supply chain is also known as value chain when the links are considered as value adding activities. There are so many activities which are adding the value. Supply chain is also considered as demand chain when the chain is considered as continuous demand originated from customers stretched to upstream suppliers. When the suppliers know the demand of the customers, they produce accordingly. So there are total 4 intrinsic flows of supply chain. There are 4 flows. The first one is material flow. In the whole process, the most important thing is material, right? So there is movement of physical goods from suppliers to the customers. Suppliers give it to the manufacturers, manufacturers give it to the distributors, distributors then deliver it to the customer retailers, and then retailers deliver it to the customers. So the first one was material flow. Then information flow. This means sharing of demand forecast, inventory levels, customer feedbacks across the supply chain. So timely and accurate information is very, very important. It prevents the organization from excess stocking and shortage also. It ensures that there is no overstocking as well as shortage of the stock. Then finance flow, that is movement of money. Without money, why these activities are being performed, right? So money is again a very important factor. Movement of money and payment. Credit also, it includes credit terms also. Customer refunds, everything is included in the finance flow. Then commercial flow. Commercial flow, it covers all the commercial transactions. It includes all the commercial transactions, all the deals, all the papers which are being signed, everything. So it covers all the commercial transaction between the parties in the supply chain. Whatever they have deal among themselves, it covers everything related to the contracts, related to the documents, everything is covered in the commercial flow. So this was about intrinsic flows of supply chain. Intrinsic flows of supply chain. Is it clear? Now moving to the next topic, that is reverse mapping. Reverse mapping. The next concept is reverse mapping. So what is reverse mapping? How business analytics is used in reverse mapping. State the types of analytics also. So this concept is about reverse mapping. Reverse mapping of business strategy is considered as an alternative to the traditional ends, ways, means of strategy formulation. So before knowing what is reverse mapping, we need to know what is normal mapping. It is an alternative to traditional ends, ways, means. This is normal mapping. So what is normal mapping? Whenever a company makes a business strategy, it is mostly a top-down one. Whenever a company makes a business strategy, it is mostly top-down strategy. That means the top level management decides what they want to achieve, what needs to be done. They decide what is to be done. This is finding the end result, what end result they want. Then ways, making strategies accordingly. This is finding ways, making strategies. And then gathering the resources. This is means. Ends, ways, means. That means initially the top level management decide what needs to be done. Okay, then they find the ways by making strategies, and then they gather the means, that is resources, which are required to achieve the goals and to make the strategy work. This is the traditional model, which is also called ends, ways, means, or normal mapping. Okay, but now it has been changed. It has been changed with the changing generation. Now it has been converted to the reverse mapping. The next alternative is reverse mapping. So ends, ways, means is a top-down approach. On the other hand, reverse mapping is a bottom-up approach. Reverse mapping is a bottom-up approach where the feed received from the customer is the epitome of the strategy formulation. Feed received from the customers. So basically what it is saying, that what is reverse mapping? In reverse mapping, initially the market data and the customer preferences are analyzed. Market data and customers preferences are analyzed. Okay. And on the basis of that analysis, on the basis of the customer's expectations, on the basis of the customer's need, business makes strategies. The organization makes strategies accordingly, according to the customer preferences and needs. So reverse mapping ensures whatever strategy is being made is aligned with the demand and the customer expectations and not based on the assumptions of top level management. Okay, this is reverse mapping. So it is a bottom up approach. Normal mapping ends base means if is top down approach, but reverse mapping is bottom up approach. Okay, this is reverse mapping. So use of analytics in reverse mapping. So it is telling about business analytics. So what is the meaning of business analytics? What is the meaning of analytics? That means analyzing the market, finding the information, finding the data, and then converting into useful insights which are necessary for taking the decisions of business. Business analytics means gathering the data and then converting it into useful information. Useful insights are being taken from that data to take the business decisions. So business analytics is used in reverse mapping. Why? Because in reverse mapping, it is need to be known that what are the customer's preferences. For that, the customer data is required. So business analytics is helpful in reverse mapping. Business analytics is the process of extracting information from raw data which may be used by the business for strategy formulation. Thus, business analytics is used to extract meaningful insights from data that can drive decision making and strategy formulation. Okay, so business analytics is used for what? The first thing is budgeting and forecast. Budgeting and forecast on the basis of the past data, on the basis of the historical sales, revenue, cost data, the future target can be decided and future can be forecasted. We can make budgets for future and we can forecast the future needs. We can predict the future also. Not correctly, not accurately, but a raw figure can be used from the past data. We can find the raw figures for future also. Then product development on the basis of the customer's needs, on the basis of the customer requirements and customer's feedback, we can analyze. On the basis of the analysis, whatever data we have related to the customers, now we know that what kind of products the customers needs. Accordingly, we can develop the product design. We can develop the product designs accordingly. Then marketing and sales. Now see what is given here. By understanding key metrics such as lead to customer conversion rate. What is lead to customer conversion rate? Lead means how the people in front of which we are advertising about our product. The people in front of which we are advertising our product, and the people who are interested are known as lead. The people who are interested to buy our product are known as lead. Okay. To customer conversion rate. Out of those people, how many are agreed to buy our product? That means how many are converted to the customers? How many are converted to our customers? This is lead to customer conversion rate. Lead to customer conversion rate. People who are interested, who are converted to our customer now. A market analyst can identify the number of leads their efforts must generate to fill the sales pipeline. That means in future how many, predicting the figure of future sales using the lead to customer conversion rate. We can forecast the future sales through business analytics. Then risk management, by understanding the likelihood of certain business risk occurring and their associated expenses, an analyst can make cost effective recommendations to help mitigate them, if through business analytics we can also find out the certainty, the likelihood of occurring the risk, and accordingly we can make the cost effective strategies. If we have the data, we can also predict the risk associated with producing any product. So this is how business analytics is used in reverse mapping. Initially for budgeting and forecasting, then for product development, producing products according to the customer's need, then marketing and sales, and for managing the risk. Now, what are the types of analytics? What are the types of business analytics? The first one is descriptive analytics. Examines past data to describe the events. So descriptive analytics is about the past data. We are examining the past data to predict the future events. Then diagnostic analytics, which seeks to understand that why the past events occurred. If we are understanding that why the past events occurred, we can be alert in the future so that we are not doing the same mistakes again. Then predictive analytics uses historical data to forecast the future trends. Then prescriptive analytics identifies actions which are required to achieve the future goals. So these are the 4 types of analytics we are having. I hope it is clear to you. Now let's move to the next topic, that is O2C, order to cash. So the question is about O2C, order to cash. An efficiently operated order to cash process creates a seamless value chain between the customer and the business. In light of this statement, briefly discuss the concept and practices used for optimization of O2C process. So what the question is saying, initially we have to tell the concept, what is O2C, what is the concept of order to cash, and then we have to tell the practices which are used by the business to optimize the O2C process. That means how it could be improved, how it could be optimized. So it is possible only through automation. What is the meaning of automation? Okay, so first let's discuss what is order to cash. What is the meaning of order to cash? So it is a end-to-end process between the customer and the business. It is a end-to-end process which starts when the customer places an order with us. When a customer places an order with us, and it ends with the receipt of payment. It ends with receipt of payment. So what steps are included in this process? See, order to cash is a process that creates seamless value chain between the customer and the business. It covers all the activities regarding customer order and initiates with the receipt of order. So it starts when the order is being received by a customer, received by an organization from a customer, and ends with the receipt of payment. Ends with the receipt of payment from the customer. It ensues the customer order and includes customer credit. Everything is included: customer credit, fulfillment of order. That is, we are providing credit to the customer, credit facility to the customer, fulfillment of the order, delivering products to them, invoicing of order, and terminates with the payment from the customer. Terminates when the customer pays to the organization. So this is order to cash process. This is order to cash process. So it creates a value chain between the business as well as the customer. Now the practices which are used for the optimization of O2C process. The first one is automation of administrative task. Now what is the meaning of automation? Automation means use of technology, use of computers, use of technology to store the data for using O2C, order to cash. Automation of O2C, automation of the process of O2C, order to cash, instead of doing it manually using the softwares and the technology, use of technology. So the first one is how it can be optimized, how the process of O2C can be optimized through automation of administrative task. That means using technology for basic tasks like billing, invoice collection, payment collection, and credit management. Using of technology, using softwares for O2C process. Everything is stored in the software, so there is no need to do it manually. Then standardization of O2C process for the entire company. That means following the same concept and same format of O2C in each and every department. A standard format of O2C is used in every department, so there is no confusion and it is easy for each and every department. Then preparation of electronic invoices instead of using paper and all, preparation of electric invoices. So there are less errors and it would lead to increased customer satisfaction. No need to give the bill in the hands of customers. Instead, electronic invoices are prepared. Then re-evaluation of credit policies. When the data is stored, when everything, we have the full history of the customers who are buying from us, how they are paying on time or not. So we can re-evaluate the credit policies. Is our credit policies up to the point or not? Which customers are capable to pay the credit on time, which are not able to do it? Which customers have credit worthiness and which are not having it? Which customers are not credit worthy? So we can evaluate our credit policies, to which customers we are going to give credit in future and which customers are not deserving it. Then efficiency in billing process. Efficiency in billing process. It supports real-time billing real-time billing process. It supports real-time billing process. That means when the service is being given, automatically the bills are generated. Immediately the bills are generated. This is real-time billing. Have you ever seen in the hospitals when they have given the service to the patient? When the patient is discharged, they immediately prepare the bill by calculating all the things, all the services they have provided to the patients. This is real-time billing. That is immediately preparing the billing and discharging the patients. So it leads to customer satisfaction. Then automated accounts receivable. Automation in accounts receivable department. So it gives the software gives the payment reminders when we have to collect the payment from the customers, archiving the customers responses, enabling online payments and settling disputes. If the customer is having any complaints, solving that, that is settling disputes. Enabling online payments, they can pay online also, giving them UPI and all. Archiving the customer responses, the previous responses, the previous history is also available to us. Then data management. Data management through software, storing all the data, all the history, so the decision making can be improved in the future and it helps the credit management. We can re-evaluate our policies also based on the past data on the customers buying from us. So this was about O2C, order to cash process. It is a value chain between the customer and the business. Now let's come to the next concept, that is customer relationship management, the most important concept of this whole chapter. Most important concept of this whole chapter. We have three questions related to this. We have three questions related to this. Okay. So question number 11. What do you mean by customer relationship management? List its advantages and benefits. So what is the meaning of customer relationship management? What is the concept of CRM? See, customer relationship management, as the title is saying, maintaining a good relationship with the customer, knowing the needs of the customers, knowing the preferences of the customers, and producing accordingly, and maintaining a good relationship with the customers. If we are having a good relationship with the customers, we will we will be earning profit. It is fixed, because if the customers are satisfied, then the organization is growing. Okay, so crm CRM is a blend of process, people, and technology. That means process should be up to the point, it should be according to the customer needs. Then people of the organization, employees of the organization, should serve the customers. They should work for the customer satisfaction, and using technology, that means using the software and all, for CRM, customer, for maintaining a customer relationship management, maintaining a good relationship with the customer, and for the whole process of customer relationship management. So it is a business strategy comprised of process, people, and technology. Okay. To maintain a good relationship with the customer, having a long-term relationship of the customer, so the customer are not leaving us, and to satisfy the customer. Okay. So this was the concept of CRM, customer relationship management. And if we have to write the benefits of CRM, see, there are so many points given. There are so many points given here. You can write 6 to 7 points. 6 to 7 easy points you can write, like satisfied customer does not consider leaving. Okay. Product development can be defined according to the current customer needs. Through CRM, when we are having a good relationship with the customers, we can develop the products according to the customer needs. When we are producing according to the customer needs, when we are giving them the best quality, there is increase in quality of products and services. We will be able to sell more products if we are having a good relationship with the customers. Then optimization of communication cost. Then trouble free run of business process. We are running those process only which are beneficial for the customers. Fast and reliable predictions. We are having a contact with the customers, we are having reliable predictions also. Increase effectiveness of teamwork, increase in staff motivation, real-time access to information. You can write any 5 to 6 or 6 to 7 points. This question is for 7 marks, in which you have to tell the concept first, and then if you are writing 5 to 6 points also, it is enough. Better communication between marketing, sales, and services. So these are the advantages of having a CRM software with us. Okay, so you can write it by your own also. The next question is, what are the different types of customer relationship management? Now this is important. We have three types of CRM. We have three types of CRM. The first one is analytical CRM. Analytical CRM. So what is analytical CRM? Analytical CRMs, basically what it does, it collects the customer data, analyzes it. It collects the customer data and analyzes it, and helps to find the useful ways, helps to find the useful insights out of that data, find useful ways to satisfy the customers. Okay, collecting the data and finding out the useful insights from the data, and then It helps the management to take the better decisions. So this analytical CRM is all about collecting data and analyzing it. Okay. Then collaborative CRM. What is collaborative CRM? It is mainly for information sharing. It is mainly for information sharing among the departments. So every department gets the same information about the customers, so that there is no confusion and fast service and consistency among all the departments. Then operative CRM. Now what is operating CRM? It is mainly for the front office workers or employees who handle the customer on daily basis, like employees who are in sales department, who are in marketing department, service department, call center, right? These employees are the front office workers who interact with the customers on daily basis. So through CRM software, through operative CRM, their work is made easy through automation. So everything is tracked and everything is stored and time is saved, right? And efficiency also increases and the employees are able to serve more customers in less time. This is operative CRM. Do you get the calls from various companies who try to sell their products to you? So from where they are getting your data? They are getting your data from various platforms. They store it, and every time they have to advertise something, they call you, right? They call you. This is their way to maintain a relationship with the customers. Contacting them and advertising their products and converting the interested people into their customers. So this is CRM, contacting the customers, maintaining good relationship with them. This is the work of CRM softwares. In CRM softwares, data is stored related to the customers, their phone number, their address, their email address, everything is stored. And when they have to advertise something, they have to tell something to the customer, they contact the customers themselves. This is customer relationship management. Now explain the misrepresentations of CRM. Now, misrepresentations of CRM. That means, what are the myths which are very popular among people related to CRM? Now we have to write the myths, the misrepresentations about CRM, and then we have to present the facts. What is false and what is true? So the first representation is CRM is merely database marketing. CRM is merely database marketing. So CRM is not just about maintaining the data about customers, but it is mostly about maintaining a good relationship with those customers. It is not about collecting the data and storing it, but it is all about maintaining a long-term relationship with the customer, satisfying the customers. Okay, satisfying the customers. So this was misrepresentation 1. Then misrepresentation 2. CRM is a marketing process. No, it's just not a marketing process, but it covers all the aspects like sales, after sales services, support services, everything. It's not just the work of marketing department, but call centers, call services, after sales services, sales department, everyone is included to satisfy the customer. Is it clear? Then misrepresentation 3. CRM is an information technology issue. What it is saying, that it's just the work of IT department. No, it doesn't ends with installing a software, but it is combined effort of people, process and technology. Without people and process, how the technology will work, right? So it is effort of people, process as well as technology. If the employees are not behaving well with the customers, if they are not trying to satisfy the customers, then technology can do nothing. So it is a It is a mixed effort of people, process and technology. So it is not merely about information technology. Then CRM can be implemented by any company. No, it cannot be implemented by any company. See, the collaborative and operative CRM. The collaborative and operative CRM can be implemented by any company, but analytical CRM cannot be implemented by any company because it is only for those companies which needs to maintain a large amount of data of customers. So big companies usually use analytical CRM, but small companies don't. So it cannot be implemented by any company. Then CRM is a technical name of loyalty schemes. No, CRM is not just about giving loyalty schemes to the customers, giving them discounts. No, it is much more than them. It is about serving the customers, satisfying the customers so that they are not leaving us. It is not just about providing loyalty points. It's not just about providing discounts and coupons, but building a long term and a good relationship with the customers. So I hope all the 5 points of misrepresentation are clear to you all. This question is very important because it is not given in your study mat, but it was asked in one of the MTPs. So there are chances that it could be asked in your exam also. So you have to write these 5 misrepresentations. Then let's come to the next topic, customer profitability analysis. Customer profitability analysis. This topic is not so important, but still we are going to discuss this. And we have 2 questions related to this. See, the concept. What is the concept of customer profitability analysis? What is profitability? Revenue minus cost. What is profit? Revenue minus cost. So profitability, customer profitability is the profit a firm makes from serving different groups of customer over a specified period of time. So this concept is for identifying that which customers are bringing profit to us and which customers are not bringing profit, which customers are loss making. So dividing the customers into different groups based on the profitability they are providing us to identify that which customers are profitable and which customer groups are not so profitable. So what are the steps to achieve customer profitability? What are the steps? The first one is customer segmentation. The first one is customer segmentation, that is dividing the customers into different groups based on the revenue and cost. Divide the customer into different groups based on the revenue and cost. Then revenue calculation. Calculate the revenue from each of the groups. Calculate revenue from each of the groups. Calculate the total sales. Then allocate the cost. Allocate the cost related to that group. Then find out the profit. Revenue minus cost is equals to profit. Then profitability analysis. Rank the groups. Rank the groups. Identify which groups are profitable and which groups are not profitable. Then strategy development. Develop strategy accordingly. What strategies are required? Which groups are to be totally eliminated? Which groups are to be kept? Which groups are profitable? Which groups needs turnaround strategy? What is turnaround strategy? Making a loss making situation, converting a loss making situation into a profitable one. This is turnaround strategy. So which groups needs turnaround strategy? And then after making strategy, after implementing it, reviewing that strategy, is it impactful or not? Is it working or not? So these were the 6 stages of customer profitability analysis. 6 stages of customer profitability analysis. So I hope it is clear to you all. Then decision grid analysis. Now we have one concept. Again, it is not covered in your study mat, but it was asked in the examination. It was asked in one of the exams. So we have to do it. Decision grid analysis is a powerful tool used to develop strategies. Now we have to learn one new concept which is related to CPA only, which is related to customer profitability only. The concept is decision grid analysis. What are the components of decision grid analysis? And illustrate the 4 segments of decision grid along with the explanation. So the components. Once we have performed the customer profitability analysis, now we need to do the decision grid analysis. Now we know each group's profitability. And now it's time to take the decision for which we are going to follow the decision grid analysis. So we have to write the components of decision grid analysis. First of all, what are the components? Initially, we need to identify the decision problem. What decision needs to be made? What decision we have to make? So we have to make the decision about the customers. Which customers are to be kept and which are to be eliminated on the basis of CPA. Then build the decision grid. What will be our criteria? We are keeping the customers on the basis of revenue or cost or what? So we need to find out the criteria on the basis of which we are going to judge the customer. Then evaluating the alternatives. What could be done? They are to be totally eliminated or turnaround strategies to be adopted. What we have to do? Evaluating the alternatives. Then scoring the alternatives. Which alternative will be beneficial and which will be not. And then making a decision. So initially identify the problem. What needs to be done? What decision we have to make? We have to make decision related to the customers. Then we need to find out the criteria on the basis of which we are going to judge the customers, on the basis of revenue, on the basis of profit, on the basis of cost, what? Okay. Then evaluating the alternatives. What alternatives are available? What could be done? Then scoring those alternatives, finding which is beneficial and which is not, and then finally making the decision. Okay. Finally making the decision. Now on the basis of decision grid analysis, customers are divided into 4 segments. The groups. The first one is loser. That means the customers which are having low sales, customers to whom we sell very less, and the customers who are providing us negative contribution. So customer with low sales and negative contribution. So the best strategy for these kind of customers is to eliminate customer having low sales, the sales volume generated is low and the contribution is negative. So the best strategy is to eliminate these kind of customers. Now here we are dividing the customers into groups, and then we are taking the decision. So what could be the decision? To eliminate these kind of customers. Then problem. Next one is problem. That means the customer which are having high sales, to whom we sell very often, but still negative contribution. Because frequently they return the products, cost associated with them is very high. There could be many reasons. Sales is good, but contribution is negative. So strategy could be turnaround. Strategy could be finding the new ways how this situation can be handled and converted into profit making situation. How they can make the positive contribution. So the strategy could be turnaround or sometimes elimination. Then potential. Potential customers are those having positive contribution but low sales. We are not selling them frequently, but still they are giving us positive contribution. Cost is very less for those customers. Cost associated with them is very less sometimes. So sale is very low but still positive contribution. So we can attract more of these kind of customers through advertising our products, through promotional schemes, and also through loyalty, giving them loyalty points. If they will buy often, we will provide them discounts, loyalty points, and many new offers. So the best strategy is to advertise and promotional schemes. And the last one is winner. That means high sales and high contribution. Customers with high sales and high contribution. So new strategies could be made to maintain these kind of customers so that they are not leaving us. These are the most profitable customers of the organization. So our study note 1 is complete. Our study note 1 is complete. This was our last topic, that was customer profitability analysis. Customer profitability analysis. Now starting our chapter number 2, that is performance measurement, evaluation and improvement tools. Performance measurement, evaluation and improvement tools. So this chapter is very important from theoretical as well as practical point of view. Okay, one practical question will definitely come from this chapter, and I will tell you which topics are important for practical. Okay, so there are 99% chances that they are going to give you question from this chapter, practical question. I am telling you about practical question. So this chapter is important from theory as well as practical point of view also. Okay, so it may be asked for 14 marks in subjective section. Okay, so the weightage of this chapter is from 21 to 28 marks. From 21 to 28 marks, which is almost 50% of SPM weightage. Okay, so this chapter is very important. Please revise it carefully and revise it as many times as you can. Okay, so let's come to the first concept, that is balanced scorecard. The first concept of this chapter is balanced scorecard. So what is balanced scorecard? Okay, so have you ever noticed when you get the results of your CMA exams? When you get the results of your CMA exams, in the report card, what is given? Only the marks. Only the marks of the subjects. Only marks are given for the subjects. But do you remember in your school time, when you were going to the school, when we were getting the report cards at that time, I remember that in the report card they used to give everything. They used to give scores for everything. Like in the first page, they gave the marks for exams, final exams for all the subjects. But in the next 2 to 3 pages, they used to give us the scores related to the discipline, related to the communication, related to sports and everything. They gave us grades, right? In my school, they used to give us the grades on the basis of sports, on the basis of communication, discipline, everything. So what do you think? Judging a child on the basis of only marks, only academics is right? No, right? The a children should be judged on the basis of everything. Is he well mannered or not? Is he is communicating well or not? Is he good in sports or not? Everything, right? That scorecard will be balanced. That scorecard will tell more about the children, right? It will tell more about the child. So this is a balanced scorecard. What is the meaning of scorecard here? Scorecard means report card. Report card of what? Report card of the organization as a whole. So balanced scorecard, this term balanced scorecard, just a second. This term balanced scorecard can be broken into two terms. The first one is balanced and the second one is scorecard. The meaning of scorecard is simple. Report card of business. And what is the meaning of term balanced? Balanced here means a scorecard of the business should focus on both financial as well as non-financial matters. Why? Because earning profit is not only sufficient. Yes, it is the main motive of any organization, I understand. But judging any organization on the basis of profit in current time is not only sufficient. We have to see non-financial measures also, that the customers are satisfied or not, right? Customers are satisfied or not. So a scorecard should be balanced. A scorecard should be balanced. It should make a proper balance between the long term goals and short term goals, financial and non financial measures, internal and external performance, everything. So balanced scorecard is a scorecard. It's a one page scorecard. It's a one page scorecard in which the vision, the mission, the objectives, goals, everything about the organization is stated. The financial measures, what we need to do financially, what are our financial goals, what are our non-financial goals, everything is stated in that one page. Okay, so it's a performance management and strategy development method. It's a performance management and strategy development method. That means the main need of any business, the main need of any balanced scorecard is to break the organization mission and vision, strategies into measurable goals, and then monitoring the performance. In that scorecard, in that one page, everything is broken into different parts. What is our mission, what is our vision, what are our goals, everything. Okay, so it is very useful for the people in the organization, for the management as well as the employees also. So planning is just not sufficient. Converting that plan into numbers and then regularly monitoring it is as important as planning. So the main goal of BSc is not to see the profit only, but to achieve the goals, satisfying the customers, learning internal, external process, everything. Okay. Focusing on internal as well as external process also. Internal as well as external environment also. So is it clear to you all what is the main meaning of balance scorecard? We should grow financially also. Internal processes should be also good, right? Employees should also grow, and customers should be satisfied. This is the main objectives of balanced scorecard, to maintain a balanced scorecard. Everything is provided at one place. Okay. Now, what are the four perspectives of balanced scorecard? What are the four perspectives of balanced scorecard? This topic is very, very important with exam point of view. What are the four perspectives of balanced scorecard? Balanced scorecard sees a company with four different angles. It sees the company with four different angles. The first one is customer perspective. Customer perspective. That means what is the perspective of customers for the company? What is the perspective of customer for the company? How do customers see us? It answers the question, how do customers see us? What is the image of the organization? What is the image of the company in the eye of the customer? Then financial perspective. How do we look to the shareholders? Are we earning sufficient profit or not? We are generating sufficient profit or not? Our ROI is sufficient or not? Return on investment is sufficient or not? we are generating much profit for the shareholders or not, we are adding value to the shareholders investment or not. Then internal business perspective, what should we do, what we should do to become the best, what must we excel at, what must we excel at. We should use innovative process, right? Delivery time should be reduced, the process should be efficient and consistent. And post service sales process, we should provide good after sale service to the customers. So what must we excel at, what must we improve to satisfy the customers, what should be our internal process. And then learning and growth perspective, can we continue to improve and create value, we are growing or not, the organization is growing or not, the employees are growing or not, their skills are improving or not, our process are improving or not. So is there scope for growth and improvement or not? So there are 4 perspectives of BSc. The 4 perspectives are customer perspective, financial perspective, internal business, and learning and growth perspective. The last one is, can we continue to improve and create value or not? I hope it is clear to you all. This topic is very, very important from exam point of view. So please revise it carefully. Then explain the benefits and limitations of balanced scorecard. The next question is describing the benefits and limitations of the balanced scorecard. So what are the benefits? What are the benefits? First, better strategic planning. So it provides a framework in which everything is being stated, clearly. What are the missions? What are the missions of the organization and exact steps to achieve them? Okay, so everything is in the form of a strategy map. It's a kind of picture in which everything is stated. So everyone knows what needs to be done and planning is better. Then improved strategy communication and execution. Improved strategy communication and execution. So it's a visual tool. It's a visual tool through which the employees get to understand that what needs to be done, that what they have to do in order to achieve the organization's goals, in which direction they need to move. So through one picture everything is clear. Through one picture everything is clear. For example, if a bank is having the goal of customer satisfaction, if a bank is having the goal of customer satisfaction, then employees which are sitting at the front desk should be clearly told. They should be clearly told that they should be polite to the customers and they should give the fast service to the customers, right? So this is the advantage of balanced scorecard. It clearly tells the employees that what needs to be done. Okay, what needs to be done to achieve the goals. Then the next point is better alignment of projects and initiatives. Sometimes what happens, all the projects of a company runs in different directions. All the projects of a company runs in different directions. So balanced scorecard gathers everything at one place. It gathers all the project at one place and ensures that all the projects and initiatives all are serving the same strategy and same purpose of the organization as a whole. Then better management information. Better management information. Through BSc, organization know their KPIs. They design their KPIs, that is key performance indicators. That means which goals are to be measured first. In simple word, measure what matters. Measure what matters, measuring the important areas first, the KPIs. Then improved performance reporting. Improved performance reporting. On the basis of the balanced scorecard, performance reports are prepared. On the basis of the BSc, performance reports are prepared. And reports don't only show the financial data, but they show the non-financial aspects also. They show the non-financial aspects like customers' feedback, employees' trainings, everything at one place. So, improved performance reporting. Then, better organization alignment. Better organization alignment. It helps to align the department and all the departments and individuals employees goals, individual goals with the organization goals, and it ensures that everything and everyone is moving in the same direction. Everyone is moving in the same direction. Then better process alignment. Better process alignment. Process like budgeting, risk management, analytics, everything is integrated together. Everything is integrated together so that the strategy is focused on the organization's goals. Okay. An strategy focused organization is prepared through BSc. Is it clear to you all? All the points, all the 7 points you have to write for 7 marks question in the exam. And if you remember, I gave you one mnemonic to remember all the points. To remember all the points. What was the mnemonic? Smart. Smart for S. Smart cats always make. Smart cats always make perfect. Smart cats always makes perfect, outstanding plans. So this was the mnemonic I have gave you in the class also. Smart cats always makes perfect, outstanding plans. This was the mnemonic, right? Do you remember this? Okay. So now let's come to the limitations part. So the first point is there is no relationship between the BSc and shareholders' value. There is no clear relationship between BSc and shareholders' value. See what happens. Business balance scorecard. Balance scorecard covers all the financial as well as non-financial measures also. But these non-financial measures are related to the customers, not related to the shareholders, right? So shareholders don't have any connection with the they only have the connection with profit. They don't have any connection with the customer satisfaction, right? They only want to know the profit. They only want to know the ROI, the share price. So sometimes what happens, the non-financial results directly don't provide any value to the shareholders, right? See, if the customers are satisfied, automatically the value will increase and the shareholders will be happy. But they don't have any direct relationship with the customer satisfaction. So this is a limitation of the BSc. Even if we are covering the non-financial measures, it is not so valuable for the shareholders. It has no direct connection with the shareholders. Okay. So through BSc, they don't think that they are getting any immediate gain. But eventually, it would lead to gain to the shareholders. It would improve the value of shareholders. But there is no direct link. It does not lead to a single aggregate summary of control. Everything is divided into different perspectives under balance scorecard. But altogether, it is very difficult to comment and summarize on all the perspectives. So management does not have a proper number to judge if the company is performing well or not. Sometimes one thing is working very good, but another is not. So it becomes to summarize all the aspects. Then the measure may give conflicting signals, and it may confuse management. Sometimes the different KPIs and different perspectives give different signals. One measure improves, but the another one gets worse. So it happens. Sometimes all the measures conflict. And suppose if we are reducing the cost, but the quality is not improving, then profit will increase, but quality will be compromised, right? Profit is increasing, but the quality is compromised. So the customer satisfaction will be low. It involves substantial shift in the corporate culture. It is not very easy to implement the balanced scorecard in the organization. It is not very easy because it demands for a corporate culture shift. Right? So it is not easy to implement. The process, the ways of working, employees' mindset, everything needs to shift in order to implement the BSC in any organization. Employees need to understand the different perspectives, the non-financial perspectives also. And training needs to be given, and it is very time consuming. So there is a total shift in the corporate culture which the employees cannot easily accept. Okay, so these are the limitations of balanced scorecard. I hope the limitations and the benefits are clear to you all. I told you the mnemonic also for benefits. In other topics also we have discussed so many mnemonics in the class, but it is not possible to cover it in the marathon session. But I hope you have written all those mnemonics and you remembered that. Now let's come to the steps in developing balanced scorecard. What are the steps involved in developing a balanced scorecard? What are the steps involved? The first one is assessment. Analyzing the external as well as the internal environment. We need to study the internal as well as external environment. Then strategy formulation, developing the customer value proposition, and defining and setting the strategic themes. So what is customer value proposition? What unique value we are going to give to the customers so that they will choose us. What unique value we are going to give to the customer so that they will choose us. This is customer value proposition. Okay, so developing customer value proposition and strategic themes. What is strategic themes? Breaking the strategy into different goals. What needs to be done first? Breaking the strategy. Basically, it is breaking the strategy into different parts. What needs to be done first? And providing the sequence to the employees. Then the third step is strategic objectives. That is setting of clear objectives to achieve the vision and mission. Objectives are the end results. These are the building blocks of the strategy. Then strategy mapping. The fourth step is strategy mapping. That means to make the strategy maps. Setting a cause and effect link. That means which action is giving what result. Setting the cause and effect link. Which action is giving what result. Strategy map What is strategy map? It's a visual diagram which links all the perspective, in one diagram. So this is how the company and the employees knows that how the goals are supporting how the goals are supported by each and every perspective, right? So this was about strategy mapping. Then performance measures, developing KPIs, making the KPIs to track the progress, setting indicators which could be measured, setting the indicators to measure the objectives. Then strategic initiatives, strategic initiatives, specific projects are introduced, to implement the strategies. Then performance analysis, measuring and evaluating the performance. Then alignment of individual to the organization's goals, alignment of individual goals to strategic goals, organization's goals. Then evaluation, that means reviewing the strategy, regular review, and if something needs to be changed, then amending it. So this topic we have covered in the exam we have covered in our classes in very detail. This topic is important, and in our classes we have covered it in detail with examples, and also I have told the mnemonic for this in the class. I hope you remember that. I hope you remember the mnemonic for this. What was the mnemonic? Can anyone tell me what was the mnemonic? All smart students study properly. All smart students study proper subjects perfectly and easily. All smart students study proper subjects. All smart students study proper subjects perfectly and easily. This was our mnemonic. In class, we have discussed this topic in very detail. I gave you examples. Related to each and every point. Those examples make it easy to learn the topic. But now in this session, it is not possible to cover the examples in detail. So you have to revise it with the examples, and you have to learn this concept in detail. Now let's come to the next topic, and again a very important topic, Dupoint analysis. Very important topic it is, Dupoint analysis. So this topic is very important for practical as well as theoretical point of view. If a practical question is being asked from this chapter, it will be definitely from Dupoint analysis. Mostly it is asked from Dupoint analysis only. So this is very important concept. Okay, this is very important concept. So what is Dupoint analysis? What is the concept of Dupoint analysis? Through Dupoint analysis, a company tries to understand its ROE, that is return on equity, in detail. It tries to understand its return on equity in detail. So it is a framework for fundamental performance of a company by breaking the ROE into three key components. It breaks the ROE, return on equity. It tries to break the ROE into three components, into three different concepts, to identify that how efficiently the company is managing its operations, assets, and capital structure. If we have the figure, the data of ROE, it's just a number, but we need to understand it in detail, that how the operations are working, how efficient is our company, and what is our capital structure. Is it efficient or not? Okay, so studying the ROE in detail to know various aspects of the organization, whether it is about operations, it is about efficiency, and when it comes to the capital structure also. So breaking the ROE into three components. The first one is profit margin, for studying the operational efficiency. For studying the operational efficiency. And what is profit margin? Measured by profit margin formula. NI, net income divided by sales. Net income divided by sales. That is, net income is PAT, profit after tax divided by sales. Then asset use efficiency. It is denoted by total asset turnover. It is denoted by total assets turnover. That is sales divided by total assets. Sales divided by total assets. And the last one is financial leverage. What is the meaning of leverage? Presence of debt in the capital structure. Presence of debt in the capital structure. So financial leverage. Financial leverage. And the formula for financial leverage is total assets divided by total equity. Total assets divided by total equity. Total assets divided by total equity. So ROE is equals to net profit margin, that is PAT upon sales, into assets turnover, that is sales divided by total assets, into equity multiplier. Total assets divided by total equity. Total assets divided by total equity. So sales and sales cancel, total assets and total assets cancel. What will remain? PAT upon total equity. So this is the formula for what? ROE, right? This is the formula for ROE. So this is the formula for ROE, PAT divided by total equity. This is how we derive the formula of return on equity. See what we have done, we have divided the return on equity into three components to see the efficiency of assets, to see the operational efficiency, and to see the capital structure, the presence of debt in the capital structure, right? So this is how we are studying the ROE in detail. We are studying the ROE in detail. So it is profitability into productivity into equity multiplier. Is it clear to you all? Is it clear to you all? In the question, the balance sheet, the figures will be given. Everything will be given. You just have to put the figures into this formula, and then you have to derive the ROE, and then you have to comment. On the operational efficiency, on the asset use efficiency, and financial leverage. You need to comment on all three aspects. I hope it is clear to you all. This topic is very, very important. Please study it carefully. Then discuss the 5 components Dupoint analysis. See, instead of breaking it into 3 parts, now we are breaking the formula into 5 parts, into 5 components. Again, we are doing it in detail. We are doing it in more detail. Now, we are going to learn the 5 component Dupoint analysis. Now, the basic 3-step model. is broken into 5-step model. It is broken into 5-step model, that is 5-component DuPont analysis, in which we are breaking the 3-step model into 5-step model. It's a extended version. It is much deeper than the 3-step model. It splits the profit, it splits the ROE into operational efficiency, interest burden, tax burden, and giving complete picture of every stage of income. It is giving a complete picture of every stage of income which is affecting the shareholders return, that is ROE. Okay, so now what are the 5-component what is 5-component model? The first one is EBIT upon sales. The first one is EBIT upon sales, not PAT. See, it is not PAT, but it is EBIT. It is EBIT. So it denotes operational efficiency. It denotes operational efficiency of the firm, in which we have not subtracted the interest, earnings before interest and tax. We have not subtracted the interest and tax. In the previous model, it was PAT, that is profit after tax, after deducting the interest and tax. But here we are taking EBIT upon sales, EBIT, in which we have not deducted the interest part and also tax. So this shows the operational efficiency of the firm. Then EBT upon EBIT. EBT upon EBIT. What is EBT? Earnings before taxes divided by earnings before interest and tax. So this will show the impact of interest. This will show the impact of interest on the firm's earning. It will show the impact of interest. EBT, earnings before tax divided by earnings before interest and tax. So what is the difference between two? Difference of interest. So it is going to show the interest burden. If it is 1, then there is no interest, right? If EBT and EBIT is equal, that means there is no interest. That means no debt. But if the figure is something else, then there is interest present. There is interest present. So it shows the interest burden. It shows the interest part in the profit. Interest part in the profit. Then EAT upon EBT. What is EAT? Earnings after tax divided by earnings before tax. Earnings after tax divided by earnings before tax. So this shows the tax burden. This shows the tax burden on the earnings of the firm. Then sales upon total assets. Same as the previous model. Sales upon total assets. And total assets upon equity. Again, same as the previous model. So this is same, this is same. But the first one, that is net income divided by sales, PAT upon sales, is broken into 3 parts. It is broken into 3 parts. So this is the 5-step DuPont analysis, 5-stage model. It is 5-step DuPont analysis. Now let's come to the question. Let's come to one question. A very easy question is given to you. It is a question asked in your exam, in a previous exam, and it is very easy. Trust me, this topic is very, very easy. If you are learning it well, you will get 7 marks, full 7 marks. And if theory portion also comes, then 14 marks. Okay, so what the question is telling us, the following financial data of 2 years has been extracted from annual report. See, data for 2 years is being given here. Of one of the world's largest generic pharmaceutical companies having a strongest presence in over 170 countries. Okay, through the company's mission is to be a leading global healthcare company which uses technology and innovation to meet everyday needs of all the patients. Yet, it also wants to keep shareholders happy by giving them a fair rate of return. Okay. For gauging return for shareholders, the company is using ROE. It is using ROE as one of the metrics of performance evaluation. Okay. Some companies use return on equity, some use return on capital employed. So, this company is using return on equity to measure the performance for shareholders as one of the metrics of performance evaluation. Because of the intense competition in recent years, its ROE is under pressure, and to maintain the level of ROE, the company is changing its business model in that it is varying its margins, asset utilization, and leverage. Use the suitable Dupoint analysis model by using financial data given below. Okay, so data is given, profit and loss statement is also given, and balance sheet is also given. Critically assess how the ROE of the company is changing due to its margins, asset utilization, leverage over a period of 2 years. Okay, evaluate the change in these parameters and recommend your comments accordingly. Okay, so what we need to do? We need to do the DuPont analysis first. We need to put everything into the formula. Then we have to comment. Then we have to comment on all the three aspects. Okay, so okay, let's start. See, everything is calculated. What is the formula? What is the three-stage model formula? If nothing is given in question, you have to use the three-stage model only. Okay. The basic model is three-stage model. So how we are going to calculate the ROE? How we are going to calculate? The formula is PAT upon sales, then into total sales turnover upon total assets into total assets upon equity. Okay, so simply you have to put the values. You have to put the values. Profit after tax is given. Okay, profit after tax we have this divided by the amount of sales. Again, total revenue is given. This we are putting it here. We will find the percentage. Okay, everything is given in the question. You just have to put the values. See how easy it is. Then we have total assets also. We have turnover also. Turnover, this we have to take here. We have to take the turnover as well as we have to take the total assets. We know the total assets. So simply we have to put here total assets also. See, now we will get the answer for this also. Then equity multiplier. What we have to do? We have to take total assets. We have already taken the total assets here. See, total assets we have this and this divided by equity. Divided by equity. So for equity, what we are taking here? Net worth. We are taking net worth. That means simply the equity share capital plus reserves and surplus. We have to take equity share capital plus reserves and surplus. Why reserves and surplus? Because it is for equity shareholders only. So share capital plus reserves and surplus. Share capital, equity share capital plus reserves and surplus. So here we are having the net worth by adding this 7550 and 8869. So in denominator we have to take that only. So we have to do nothing, just we have to put the formulas. Just we need to put the formulas and then multiply everything. Then multiply the answer of this, this and this. We need to multiply the answers, nothing else. See, here we have the answers. Multiply it, multiply all the three aspects, and then you will get the final answer of ROE. You will get the final answers of ROE. Okay. So now we have to comment on this. Now we need to comment on this. See, the ROE is increased, right? The ROE is increased from the previous year to current year. It is increased from 14.88% to 16.98%, right? And the main reasons for the increase are margin and leverage, which has increased due to lower assets utilization. What are the main reasons? See, our net profit margin is also increased, right? And our assets are also increased. See, our assets are also increased. So if the margin is increased, our profit is increased. Also, the assets are also increased, right? But one second, just for wait for a second. Sorry. Notice one thing. Our asset to equity ratio has increased. Our asset to equity ratio has increased. That means leverage has increased. But due to lower asset utilization, ROE has not increased by its full potential. See, our assets to turnover ratio has decreased. Our assets to turnover ratio has decreased. That means the assets are not performing well to generate the sales. Assets are not generating sales up to the point. So the ROE has not increased to its full potential. So if the company concentrates on better utilization of assets, that means to generate higher sales from the present assets, then the ROE will further improve. The ROE is going to improve further. See, both the other aspects are increasing, but we are lacking in assets turnover ratio. That means we are not able to generate higher sales from assets. That means we need to improve in that area. We need to generate more sales from the present assets, right? Then only the ROE can perform to its full potential. It could be increased to its full potential. I hope it is clear to you. I have not solved it in detail because it is very simple. You just have to put the values. In class, we have done so many questions of Dupoint analysis, that too in detail. It's just a revision session, so I'm not solving it in detail due to limitation of time. But it is very easy. You just have to put the formulas, nothing else. So that was all about Dupoint analysis. So let's come to the next concept, which is benchmarking. Our next concept is benchmarking. Again, important with exam point of view. It is an important topic and it is a very easy topic. Okay. So what is benchmarking? Suppose you gave an exam, right? You gave an exam, you got results. Just by watching your own marks, would you will be able to know that you are the best student or not? Would you get to know that you are best student or not? But if you are comparing your marks with someone else, if you are comparing your marks with someone else, and now you are knowing your position in the classroom, you are knowing the position in the whole class, then only you can tell anyone that you are best or not, in what position you are standing. But when you are comparing your marks with topper, when you are comparing your marks with topper, you will get to know that in what points you need to improve. What is your real position? What are the areas of improvement? How much you need to improve, right? By comparing from others only, you can know that what is your position. And by comparing with the topper, by comparing with the topper only, you will know that how much you need to improve in order to become the best, right? This is only benchmarking. This is benchmarking. This concept is known as benchmarking, that is comparing one's process, product and serving with industry's best practices. Comparing the process, products and services with industry's best practices. Adopting the industry's best practice is known as benchmarking. getting to know that how much improvement is needed and how it can be improved. In a summarized way, adopting the industry's best practices is benchmarking. Okay, the practice of setting targets using external information is benchmarking. It involves a comparison of actual result with established standard or target. So it is a process with which the performance is sought to be assessed. We need to assess the performance by comparing it with the industry's best practices, and we need to know how much improvement is required. How much improvement is required. So now we are going to learn the types of benchmarking. Now it's time to learn the types of benchmarking. See, it could be categorized in two. It could be categorized on two factors, on the basis of two factors. The first one is who is being benchmarked. Who is being benchmarked with whom? With whom we are being benchmarked. And in the next category, what is being benchmarked? What is being benchmarked? So the first category is nature of business. The four types of benchmarking classified according to the nature of business they serve are enumerated below. The first point is internal benchmarking. And the meaning of internal benchmarking is comparing the different departments of the same organization. When we are comparing with the department in our organization only, other department in the same organization, it is called internal benchmarking. We are comparing with the department in the same organization. Then competitive benchmarking, directly comparing with the competitors. Directly comparing with the competitors. This is competitive benchmarking. Then industry benchmarking. Then industry benchmarking, comparing within the same industry but not with the competitor. Comparing with a organization in the same industry but not with the competitor. Suppose I have to compare my college. I have a college. I run a college. I have to compare it with some other college. Like my college is in Karnataka. I want to compare it with the best college, DU, Delhi University, a best college of DU, Delhi University. So I am comparing a college in the same industry, but is it a competitor? No, it is not my competitor, right? I have a college in Karnataka, it is in Delhi, right? So we are not competitors, but still we are in the same industry. So this is industry benchmarking. I am not directly competing with the competitor, but I am comparing with a industry. I am comparing with a college in the industry, organization in the same industry. Then the fourth one is generic, comparing with the unrelated industry. Comparing with the unrelated industry. We are not in the same industry also, comparing with some other organization in some other industry. Like comparing a chocolate making company with some mobile company or something else. This is generic benchmarking. So this was based on the nature of business with whom we are comparing. With whom we are comparing. Then next one is what we are comparing. Our product, our process, our performance, what? So the first one is product benchmarking. The first one is product benchmarking. In this, what a company does, it buys a product. It buys a product of some other company. For example, Samsung buying a phone of iPhone and then studying the features in detail and adopting the best features of iPhone. This is product benchmarking. Samsung improving by watching the iPhone's quality and features. Then process benchmarking. Adopting the best industrial process. Adopting the best process. The company compares its business process with some other industry's best practice, and adopt whatever is lacking. Okay, so the performance is improved. Then performance benchmarking. Performance benchmarking through comparing the numbers like cost per unit, the sales amount, the sales data, sales numbers, okay, delivery time, defect rate present. This is performance benchmarking, comparing the numbers, quantitative data. Then strategic benchmarking, comparing the strategies, comparing the long-term strategies like planning, business model, etc. For example, Apple maintains its premium quality, right? Apple maintains its premium quality, premium pricing model. So it has innovative strategies also. So Samsung can adopt all those strategies what the Apple is having. So comparing on the basis of strategy. This was all about benchmarking. Now let's come to the next concept, Six Sigma. So explain the concept of Six Sigma along with the 7 key roles in deployment of Six Sigma. So first of all, we need to understand the concept of Six Sigma. What is Six Sigma? It is a statistical concept. So it is a quality improvement method. This concept is focused on quality improvement, and the main purpose of Six Sigma is to reduce or completely finish the defects in the process. It is reducing or completely finishing the defects in the process. This is Six Sigma. It is a statistical term. Six Sigma is a sigma is a statistical term, okay, which represents standard deviation. And what does standard deviation tells us? Standard deviation tells us that how much our data is deviated from the standard. How much data is deviated from the standard we have set. Okay, so if the standard deviation is more, that means there are more variations. And the quality is unstable. But if the standard deviation is low, that means the process is stable and the quality is much better, right? So sigma means standard deviation, and it shows the variations from the actual variations between the actual performance and the standard performance. So variations should not be more in number. It should be less. It should be very less. So defects have to be reduced or they have to be eliminated completely. There are 3 more names of Six Sigma. What are those names? Operational excellence, zero defects, or customer perfection. Our process should be perfect. There should be no defects, right? Or operational excellence. So the main purpose of Six Sigma, what is the main purpose of Six Sigma? To identify the errors and variations in performance, right? Identifying the errors and defects in the process and variations in the performance, right? Then understanding the root cause of the error. And then analyzing, measuring, and improving the process. Analyzing the defects, measuring the defects, and then improving and controlling the process. This is the main purpose of Six Sigma. For example, I have a pen producing factory. And in each batch I produce 1,000 pens. Out of which 50 pens are not working in a right way. 50 pens are not working. Okay, so we have to reduce this number. Initially we need to find out that what are the errors, what are the defects, right? I know 50 pieces are defective. Why it is happening? where we are lacking, right? And then I will try to reduce those errors, reduce those defects, and to totally eliminate it. I will try that no pen is defective, and if the defect is exist, it is less in number. It should be very least in number. Okay. Now, 7 key roles for successful deployment of Six Sigma. 7 key roles of successful deployment. So all the employees in the organization are given some role in the Six Sigma process. All the employees in the organization are given some roles. So what are those roles? What are those roles? The first one is executive. The first one is executives. These are basically people from top level management like CEO, senior leaders, and their role is to set a clear vision and direction for the Six Sigma implementation. And they ensure that it's just not a product but a permanent practice. It's a permanent practice. They provide resources and authority and support for Six Sigma implementation. Then second one is champions. Those who implement the Six Sigma in the organization are known as champions. These people ensure that the Six Sigma is properly integrated in all the departments. So they implement the Six Sigma process in the organization. Then masters. Masters are identified by the champions. Champions select the masters. So these masters are the full-time experts or full-time coach, and they give their 100% for the Six Sigma projects. They give their 100% time to Six Sigma project and assist the champions. These are selected by masters are selected by champions. Then experts. These are advanced level professional. These are advanced level professional having a very high knowledge and experience in the field of Six Sigma. Okay. Then black belts. These people work under the masters. These people work under the masters. These people work under masters. So black belts work under masters. These people also give their full time to the Six Sigma projects. These people also give their full time to these projects. They just implement whatever they are told by the champions and the masters. But they give their 100% time to the Six Sigma projects. Then green belts. These are the normal employees of any organization. These are the normal employees of any organization which take part in Six Sigma along with their regular job. They take part in the Six Sigma process along with their normal job. So their role is just supportive. Their role is just being supportive, and they don't take full time. They don't give their full time to this Six Sigma jobs, but with their regular jobs, they are supporting the organization in Six Sigma process. So these are green belts. Now yellow belts. They are trained but not actively involved. They are also trained for the Six Sigma procedures, for Six Sigma process, implementation of Six Sigma, but they are not actively participating currently in the Six Sigma procedure. They just know what is Six Sigma, how it is implemented. They are trained, but recently they are not working in any Six Sigma projects, but they have knowledge about it. Okay, they are equally trained about it, trained for it. So these were the key roles for successful deployment of Six Sigma. Now the next topic is lean management. Lean management. So what is lean management or lean manufacturing? What is lean management or lean manufacturing? See, lean manufacturing is a strategy. It is a strategy. It is a strategy or a system which aims at producing more output. It aims at producing more output with less resources. That means the organization should be more efficient. It helps the organization to become more efficient. Producing more output with less input. Producing more output with less input. That means creating more value with less wastage. Creating more value with less wastage and reducing the cost. So the purpose of lean manufacturing is to save the time, eliminating the waste, and to increase the productivity. Increasing productivity and efficiency, eliminating waste and saving the time. Okay, so it ensures that there is no excess stock, there is no unnecessary steps, no extra movements, and no overproducing in the organization. Basically, least wastage or no wastage, reducing the wastage, reducing the wastage of resource. So, what are the 5 principles of lean management? What are the 5 principles? The first one is value. What is the value in the eye of the customer? Which feature or which feature in a product is being considered as value by the customer? Which feature in the product uh, is considered as value by the customer? If the customers considered fast delivery as value, that then fast delivery is the value in any product. Then value stream. Value stream. Which element in the value chain is the most important one? From producing products to delivering it to the customers, from producing product to delivering it to the customer in values stream, which element in the chain is the most important one? Which step is adding value? That is value stream. That is value stream. So in value stream, we are identifying that which elements are bringing value and which are totally wastage. Okay, so the first was value, second one was value stream, then flow. That means the production process should be continuous and the flow should not be broken. There should be no delay in delivering, in producing, and there should be no wastage and the flow should not be broken. Okay. If the machine is not working well, then the flow is broken. If the raw material is bought late, then the flow is broken. If the workers are sitting idle, again the flow is being broken. So the flow should not break. It should be smooth and continuous. Okay. Then pull. See, there are two concepts in SPM. The first one is push and the second one is pull. Push means initially you produce and then try to sell it. Okay, initially producing and then try to sell it. Whatever you have produced, try to sell it. This is push. Okay, then what is pull? Producing according to the customer demand. Only that much production which is required, which is demanded by the customers. It is pull. So lean management is focused on pull, so that there is no wastage of resources, there is no excess cost of storing and carrying cost, and there is no excess inventory. This concept is known as pull. And the last one is perfection. Improving the system from time to time and having continuous check if there is any wastage, if the employees are working well or not, the quality is improved or not, improving or not, see the daily improvements, reducing the errors, etc. So bringing perfection in the organization. These are the 5 principles of lean management. These are the 5 principles of lean management. Then there are 5 S. There are 5 S of lean management. 5 S of lean management. What are those 5 S? The first one is, see, in implementing lean, the 5S quality tool derived from 5 Japanese terms beginning with the letter S are used to create a workplace suited for visual control and lean production. So there are 5 terms of Japan which are used in the lean manufacturing. And what are those 5 terms? The first one is Seri, that means seri. Seri means to sort. Seri means to sort. That means whatever is useful, keep it. Whatever is useful, keep it. Discard the other things. Whatever is useful, keep it and discard the other things. This is Seri. Then set on. That means set in order. Set on means set in order. Arranging the useful things which are identified in the previous step. Arranging those useful things in order and in correct place. Arranging the useful things in correct place. So if everything is on place, there is less wastage of time and less wastage of resources. Each and every employee in the organization knows that where the resources are kept, where everything is kept, what is the order and what is the place of each and everything in the organization. And it, trust me, it saves a lot of time. It saves a lot of time. Then the third one is say so. That means to clean daily and maintaining everything. To clean daily. If the workplace is clean, it is always safe and efficient. There is no wastage of time. And everything should be clean. So it will be safe for the employees working there. Then Shiketsu. The fourth one is Shiketsu. That means to standardize. To standardize. Make the above 3S. Make the above 3S as a daily habit. This is Shiketsu. Making the other 3S, that means Seri, Seton and Seiso, as daily habits. So it should be covered in the daily routine. It should be included in the daily routine. The goal is everyday consistency. The goal is everyday consistency. And the last one is Shitsuke. The last one is Shitsuke. That means developing and sustaining discipline in the organization. Developing and sustaining discipline in the organization. Employees should be trained in that way that the 5S becomes the habit in the organization. And it becomes a culture. It becomes a habit and a culture in the organization. So these were the 5S of the lean. These are the 5S and the principles of lean management. Now let's come to the next topic, that is management information system. Explain the objectives of MIS, management information system. Discuss the different types of MIS report. So what is the, we have to tell the concept and the objectives of management information system, and then we have to tell the types of MIS report. So first of all, what is MIS? What is management information system? As the title suggests, management information, providing the information to the management. See, it is a systematic process in the organization. It is a systematic process in which the organization collects the data, processes the data, stores the data, analyzes the data, and provides the internal data to the management. It collects, it processes, it analyzes, it stores, and then it provides the data to the management, providing the internal data to the management. This is called management information system. It is called management information system. So these data is given to the management so better decisions could be taken. Okay, better decisions could be taken. See what happens in large organization. In big organizations, there is too much amount of data. Okay, too much amount of data related to sales, related to inventory, related to finance and employees. So what is the purpose of MIS? What is the purpose of having a management information system, the software for MIS? What is the purpose? To convert the data into meaningful insights which could be given to the management so that they can take the better decisions. The management can take the improved and better decisions. This is the purpose of MIS. Now let's see the objectives of MIS. See, the first one is to provide the managers at all levels with timely and accurate information. That is, managers get the information at time, and that too correct and accurate information. Then it highlights the improvement areas of business. It highlights the improvement and important areas of business. For example, low sales zone. In that area we need to improve, and it is important also. Then high cost areas, poor performance areas, so customer complaints. So to improve the performance, we need to know the important areas and where we need to improve, so the management can take the decisions on the basis of the data provided to them. Okay, then develops a communication system. In MIS, a communication system is developed. It makes the communication flow through reports. In MIS, communication flows through reports, emails, and alerts. So everything passes in one single system and there is less confusion. So better communication in the organization. Then the fourth one is programmed decision making. The fourth one is programmed decision making. That means it provides tools and techniques so that the routine decisions can be taken quickly and automatically. Routine decisions can be taken quickly and automatically. So it provides tools and techniques for that. To provide best service to the customer, obviously the service will be best if the management is good, if the management knows what decision needs to be taken. Then to gain competitive advantage, okay, to provide information support for business planning for future. So these are the objectives of MIS. We can also do future planning through it. We can forecast the future sales, future budget, resource planning, and everything. Okay, expansion decisions. So if the management is having the data, it could take decisions for present also. It can forecast the sales and figures for future also. So the management becomes efficient through MIS, Management Information System. Now, what are the types of MIS? What are the types of MIS reports? What are the types of MIS reports? So basically there are 12 types of MIS reports. The first one is summary reports. The first one is summary reports, which summarizes the large data, of sales, profit, inventory, everything. Then trend reports. Next one is trend reports. What trend is going on? What trend is going on? Is the sales increasing year by year or is it decreasing year by year? Like that for everything. Then predictive reports, which uses the past data to predict the future. It uses the past data to predict the future. Then exception reports. Exception reports. That means what are the unexpected and unusual events which has happened in the organization. Is there any unexpected or unusual event occurring in the organization? Then on-demand reports, which are prepared on the demand of the management. It is prepared according to the management request. For example, if the management wants to see the region-wise sales, the management wants to see the region-wise sales. So this is an on-demand report. Then financial reports. It contains the company's financial performance, that is balance sheet, P&L statement, profit and loss statement, cash flow statement, etc. Then inventory reports. Inventory reports. It manages and tracks all the products in your inventory. How much inventory is there in the organization? What products we are selling? Everything. Then sales reports. The next one is sales report. How much sales in specific period? How much we are selling in a specific period? Then budget reports. It contains income. It contains the information related to income, expense, budget, budgeted versus actual performance also. Then production reports. It contains production activities in detail. It contains the information related to the production activities in detail. Then cash flow reports. It shows the inflow and outflow of cash. Shows the inflow and outflow of cash. How much cash is coming and how much cash is spent. And the last one is cost report. That means department-wise cost analysis. Production cost, manufacturing cost, everything is separately provided in these kind of reports, cost reports. So these are types of MIS reports. Types of MIS reports prepared. Is it clear to you all? Is it clear? Now let's move to the last topic, that is TQM, Total Quality Management. Now the next concept is Total Quality Management, the last concept of this chapter. See, this concept is very similar with Six Sigma, but it is similar but not same. It has differences. Six Sigma and TQM are different in their own ways, but they are similar concepts. So what is TQM? What is the meaning of total quality management? It means minimizing the defects in the products. Minimizing the defects in the products to zero or minimum. But from the starting point, producing and designing the products in such a way that there no defect exist. That no defect exist. So it is started from initially from designing the product. The product is designed in such a way that there is no chance for any defect, and if defect exists, then reducing its and minimizing it. Okay, so the whole focus is on improving the quality through each and every employee in every department in each and every stage. Okay, this is the concept of total quality management. So it ensures that the products are designed in such a way that there are no defects. Okay, best quality while manufacturing. The quality should be best while manufacturing. It ensures that there are no errors in the process. It tries to give zero error in the process. There should be no error in the process. And if there is any defect, then identifying it immediately. It is the motive of TQM. Now, there are three core concepts of TQM. There are three core concepts of TQM. The first one is quality control. First one is quality control, which focuses on the quality of past. It identifies the past mistakes, identifying the past mistakes and taking actions accordingly. This is quality control. Then quality assurance. It focuses on the present quality. It ensures that the present quality is best. That means maintaining the whole system in such a way that no defect exists in the process and there will be no defect in future also. In simple words, making the process strong. Then quality management. That means managing the future quality. It aims at long-term improvement. This aims at long-term improvement. It should be a culture in the organization where everyone is continuously improving so that there are no defects in the future. So the first one was about past, second about present, and the third one about future. Now what we have to do, we have to distinguish between the Six Sigma and TQM. We need to differentiate. We need to distinguish between the Six Sigma and TQM, how these concepts are different from each other. We have to write that how these concepts are different from each other. See, both aim at improving the quality, but the approach is different. Both aim at improving the quality, but the approach is different. See, the first point of difference is Six Sigma is relatively a newer concept than TQM. TQM is comparatively a traditional, older concept. and it's a philosophy in itself which improves, in which every employee, everyone in the organization contributes. But six sigma in Six Sigma everyone is contributing, okay, but there are key roles assigned to various individuals for implementing the projects. So it's a newer concept. It is a statistical tool which aims at removing the defects and satisfying the customer. Then focus. The focus of TQM, Total Quality Management, is on existing quality standards and continuous improvement. And the focus of Six Sigma is to minimize the defects and problems. Problems should be solved on the basis of the collected data. Then implementation. The third point is implementation. Six Sigma is much more complex than TQM. The implementation of Six Sigma is complex because data needs to be analyzed. Statistics is also involved. Special training is to be given to the employees. And TQM, in TQM there is no special training required. Okay, it's a culture or it's a mindset in each and every employee. It's a mindset of each and every employee, and it's a culture in the organization. It is natural. It doesn't needs to be trained. The employees doesn't needs to be trained for that. Then the last one is results. The results of Six Sigma is fast and accurate, and it is always measurable. It is always measurable because decisions are based on the customer's feedback and the data. Customer feedback and data. But in TQM, the results are very slow and the results are less measurable. These were the 4 points of differentiation. The first one was focus, second was implementation. Sorry, the first one was Six Sigma is a newer concept. Then second one was focus, then implementation, and the last one was results. Last one was results. So I hope it is clear to you all. Now one more question, that is steps for implementation of TQM. Steps for implementation of TQM. Here I have gave you the summary, a summarized chart. I have gave you a summarized chart, so it becomes very easy to remember the points. So what are the steps involved for TQM implementation? What are the steps? The first one is identifying the customers. The first one is identifying the customers, that who are our customer, to whom we are selling, what are the age groups and all. Okay, identifying the customer groups, identifying different customer groups. Who are the customers? Female, male, old people, young people, children, who are our customers. Then listing their expectations, what they are expecting from us, whether it is fast delivery, quality product, low price, what they are expecting. Then identifying decision requirements, what needs to be done for the customer's expectations, what steps needs to be taken. Then perceive problems, that is identifying problems which are making the process slow and defective. Then benchmark with others. Benchmarking with others, that means adopting the industry's best practices, benchmarking. Then gather customer feedback. Okay, then identifying opportunities. Identifying opportunity, that is what are the chances of improvement. Identifying opportunity and improvement areas. And the last one is implementation of improvements. Implementation of improvements. Now we know that where we need to improve, now implementing it. Okay, so the goal is quality improving. Goal is improvement of quality, reducing the defects and customer satisfaction. So these were the steps. I have explained you it in very simple manner. These are the steps for TQM implementation. So these are the benefits of charts, summarized charts. In less than 2 minutes, we have discussed the whole topic of steps of implementation. So I hope it is clear to you all. I hope it is clear. Now our chapter 2 is also over. Now let's come to study note 3. Chapter number 3. Now let's come to the chapter number 3, study note 3, that is economic efficiency of the firm, performance analysis. And this chapter is very important from practical point of view, because one question will be compulsorily be asked from this particular chapter, and that too in question number 3a. So the place of this chapter is fixed in question number 3a. One question of 7 marks you will definitely see in your exam in question number 3a from this particular chapter, chapter number 3, and that too a practical question. So theory is not very important for this chapter. You can read it from study mat, because it is asked in MCQs only. So you have to cover it from the study material, and you have to practice as much as questions possible, practical questions for this chapter. And some students find this chapter very difficult, but no, it's not like that. It's just opposite. This chapter is very easy. Trust me, after this revision session, after this marathon session, you will feel very confident about this particular chapter at least. Okay, so what is the chapter? Economic efficiency of the firm, performance analysis. See, very basic formulas are given here related to revenue, cost and profit. These formulas are very basic. You have learned it in your class 11th and 12th, I guess. These formulas are very easy. The formula for revenue is quantity sold into selling price, right? Then average revenue. What is the average revenue per unit of product? Total revenue divided by number of units, right? Then marginal revenue. Change in revenue divided by change in quantity. That means how much revenue is being changed due to change in quantity. If we are decreasing or if we are increasing 1 unit of product, then how the revenue is going to change, how much the revenue is changing. So change in revenue divided by change in quantity. This is marginal revenue. And now this thing, differentiating, I will tell you what it is. Then similar formulas for cost and profit are also given. Okay. So now the main concept of this chapter, the main concept which we have to apply in this chapter is differentiation. The main concept of this chapter is differentiation. So this chapter is based on differentiation, and there are two concepts. There are two concepts of differentiation, that is maxima and minima. Maxima and minima, that is maximization and minimization. So when do we maximize? When do we maximize? When the question is about revenue and profit. When the question is about revenue and profit, maximization should be applied. And when question is talking about cost, minimization should be applied, right? Because we need to maximize the profit and revenue, and we need to minimize the cost. So these two are the parts of maximization and minimization. And these two are the parts of concept differentiation. So we are going to learn differentiation. Differentiation. So it is a very simple concept. It is a very easy and simple concept. See, suppose one equation is given for total cost. Let it be C. One equation is given for the total cost, and the equation is 4x square plus 8x plus 12. Okay, one equation is given. We need to find the number of units. We need to find the number of units where the cost is minimum. X being the number of units. So basically we have to find the number of units. We have to find the X number of units, and we have to tell that is it possible to minimize the cost or not? Does minimization exist or not? So one equation is given. So now what we need to do? We need to differentiate this equation. We need to differentiate this equation 2 times. We need to differentiate this equation 2 times. Now what is the meaning of differentiation? What is the meaning of differentiation? See, what we do in differentiation, basically what we do, we bring this power. This power is given 2, this power is 1. When nothing is mentioned, the power is 1. And here, no variable is given with 12. Okay, I will tell you why. So what we need to do, we need to use this power to differentiate. So basically what we have to do, we have to bring this power here. We have to bring this power here before the variable given. Before the variable given. So the variable is 4x, right? So we have to bring the power here to multiply. And now what will happen? Suppose the power is n. Suppose the power is n. So what we need to do? We need to minus 1. We need to subtract 1 from it. So now it will be 2 minus 1. It will be 2 minus 1. And what we have done? We brought this 2 here in front of 4x. Now for 8x. 8x, x to the power 1 is given. When nothing is given, that means it is 1. Right? So what will we do? We will bring this 1 here before 8x. Okay. Now n minus 1. Always remember n minus 1. 1 minus 0 will be 1 minus 0 will be 1. Sorry. 1 minus 1 will be 0. It will be 0. Plus 12 is not having any variable. 12 is not having any variable. It is constant, and the differentiation of any constant is 0. The differentiation of any constant is 0. You have to remember this. Differentiation of any constant is 0. Okay. And what it is told, what we are doing here, we are differentiating cost with respect to the quantity. This procedure is called differentiating the cost with quantity. Differentiating the cost with the quantity. So we are differentiating it. Now what will be the result? 2 into 4x, 8x to the power 1. Okay, 8x to the power 1 plus 1 into 8x to the power 0. See, x to the power is always 1. X to the power is always 1. So here it will be x to the power 0. So it will be 1. 1 into 8 into 1. 1 into 8 to the power 1. That is, it will be 1 into 8. It will be 8 plus 0. So what is remaining? 8x plus 8. What is remaining? 8x plus 8. 8x plus 8. Okay. So we have differentiated this equation. We have differentiated this equation. dc upon dx. dc upon dx. What we have done? We have differentiated it. And we have to differentiate it 2 times. We have to differentiate it 2 times. And this is called necessary condition. Necessary condition. When we are differentiating it for the first time, it is called necessary condition. That is first order derivative. First order derivative. It is first order derivative. Okay. And now, what is the necessary condition here? What is the condition we need to do? What we need to do? We have differentiated it first, right? We have differentiated it. And now we have to equate this first derivative with 0. We have to equate it with 0. We have to equate it with 0. So dc upon dx is equals to 8x plus 8 is equals to 0. So it will be 8x minus 8. X will be minus 8 divided by 8. It would be minus 1. It will be minus 1. It will be minus 1. Okay. So this was first order derivative. It was first order derivative. Now we need to again differentiate it. We need to again differentiate, but not the same equation. Now we need to differentiate this, the answer of first derivative. We need to differentiate this. So it will be, now this is second order differentiation. So it will be d square c upon dx square. It will be, we have to write it like this. We have to write it like this. There is no meaning of this. Okay. Now we need to differentiate this. So x to the power 1, bring this 1 before 8x. Okay. Plus this constant will be 0. Right? It will be 0. And now this 1 will become 1 minus 1, 0. So what will remain? 8. What will remain? 8. Right? Only 8 will remain. So the answer of second order derivative is 8. The answer for second order derivative is 0. Now when we are differentiating it again, it is called second order derivative. It is called second order derivative. Okay. It is called second order derivative. And also sufficient condition. It is also called sufficient condition. So if any equation is given, we have to differentiate it 2 times. We have to differentiate it 2 times. Okay. We need to differentiate it 2 times. The firstly we have to differentiate it first order derivative, that is necessary condition, and then we have to equate it with what? Equate it with 0. We have to equate it with 0. And then what we need to do? What we need to do? We have to find out the second order derivative also. We have to find out the second order derivative also. In second order derivative, what we have done, we have equated this, the answer of first order derivative. We have differentiated the answer of the first order derivative again. And what is the answer? Answer is 8. The answer is 8. Okay. The answer will be 8. Understood how we have differentiated it? 1 minus 1, 0. And then we have brought the 1 here before 8x. X to the power 0 is equals to 1. So 8 into 1 will be 1. 8 to the power 1 will be 1. And 8 into 1 again 1. 8. So the answer is 8. That is positive. The answer is positive. Now, how do we know that the maximization or minimization exists or not? How do we know that the maximization or minimization exists or not? See, when the answer is positive, when the answer of second order derivative is positive, when the answer of second order derivative, if answer of second order derivative is positive, that means minima exist. If the answer of second order derivative is positive, that means minima exist. And if answer of second order derivative is negative, that means maxima exist. That means maxima exist. So this is how we minimize the cost and maximize the profit. So what was the question? We had to find out the number of units, that is x, number of units at which the cost will be minimum. And yes, the minima exist because the answer is positive, right? The minima exist at the number of units x, and we have found the x as -1. See, units can never be negative, right? Units can be never be negative. So the answer will be positive here. The answer will be positive here. Definitely it will be positive. But this equation, this is an imaginary equation which I have made to explain you. So there will never come a situation when this will be negative. Okay. In this question, it is coming negative, but it will not happen in any of the questions for sure. It was an imaginary equation. Okay. But I hope you understood what we have to see. We have to see the second order derivative. If the answer is positive, that means at the number of units which we have calculated x, at that number of units, our cost is minimum. Our cost is minimum. And if the answer is negative, then maxima exist. Then maxima exist. And for cost, we have to minimize. Okay. So is it clear to you all? I hope it is clear to you. Okay, so let's come to the questions. Let's come to the questions. Steps are also given for minimization and maximizations. Please read it. Read it by yourself. All whatever I have told you is given. Okay. Now questions are given here. We are going to solve the questions. Let's come to the question number 1. Let's come to the question number 1. A manufacturer sells Q items. A manufacturer sells Q items. Instead of X, Q is given. The number of units are Q. At a price is given. Equation for price is given 330 minus Q. Okay. 330 minus Q. The price is 330 minus Q. Cost of producing is Q square cost, that is total cost is given, Q square plus 10Q plus 12. Q square plus 10Q plus 12. See, one thing I forgot to tell you that, see, one thing. This is a variable Q, okay, number of units. This variable is Q, that is number of units. In the equation I told you it was X. Instead of that, now it is given Q here, okay. It could be anything, X, Y, Z. It could be given anything in the question. So here it is specifically given that Q can sell Q items. That means it is quantity. See, as you know, which the costs which are dependent on the quantity are variable cost, right? The cost which change with the quantity of goods, quantity of units is variable cost. So can you say that these two are dependent on the variable Q? So this is VC and this is constant. So it is FC because no variable is given here, right? No variable is given here. And no variable, it is not dependent on the variable. That means it is constant. So it is fixed cost. It is fixed cost. Okay. So equation for total cost is given and equation for price is also given. Okay. Now we have price. Now we have total cost. What we need to do? Compute how many items should be sold to make the profit maximum. Initially we need to find out the profit and in how many number of units the profit will be maximum. In how many number of units the profit will be maximum. So initially we need to do to see that if the maxima exist or not, because it is talking about profit. So concept of maximization will be used. And another thing, At how many number of units the profit will be maximum? Okay, so let's solve it. Let's solve it. I'm solving it here only, so you can compare with the answer also. See, we have price 330 minus quantity. Then we have what? We have revenue. Sorry, we have total cost. That is, we have total cost. Q square plus 10Q plus 12. Okay. So how can we find out the profit? How can we find out the profit? The profit is equals to revenue minus cost, right? So we are not having revenue. We are not having revenue. But we know that number of units is equals to Q. Number of units is Q. Number of units into selling price will be revenue, right? Number of units into selling price. See, it is given here. Quantity sold into price per unit. So we have quantity sold, that is Q, into price per unit, that is 330 minus Q. So the revenue will be 330Q minus Q square. 330Q minus Q square. Now, what will be the equation for profit? What will be the equation for profit? See, here it is X. It is a misprint. Here it is taking profit as X. Here we have to find out the equation of profit. So what is profit? Revenue minus cost, right? Revenue minus cost. So what is our revenue? 330Q minus Q square minus the equation of cost, that is Q square plus 10Q plus 12. Understood? So it will be 330Q minus Q square, again minus Q square, then minus 10Q minus 12. Okay, so this will be our equation for profit, which will be X. Which will be X. So what we need to differentiate? We need to differentiate profit, because we need to find the maximization of profit. So we need to differentiate the profit. Okay, so how we will write it? See, the simplified equation will be 330Q minus 2Q square minus 10Q minus 12. So it will be 320Q minus 2Q square minus 12. This will be the equation of profit. We have taken the equation of profit as X. We have taken the equation of profit as X. Let us continue here. Now we have the equation of profit. We have profit as 320Q minus 2Q square minus 12. Okay, we have this is the equation of profit, and we need to differentiate profit with the quantity, right? Always we have to differentiate with the quantity. So it will be dx upon dq. Dx upon dq. Now we are differentiating it for the first time. First order derivative. First order derivative. So what will we do? Here it is 1. So 1 into 320Q. Now the power will become 0. 1 minus 1, 0. Minus 2 into 2Q. And here 2 minus 1 will become 1. Minus the constant will be 0. Okay, constant will be 0. The differentiation of constant is 0. So this will be 320Q. And this will be this will be 320, because Q to the power 0 is 1. 320 to the power 1. It will 1 into 320 minus this will be 4 This will be 4q. This will be 4q. So the equation is, the first order derivative is 320 minus 4q. The first equation is, first order derivative is 320 minus 4q. Now what we have to do? We have to apply the necessary condition. We have to apply the necessary condition. And the necessary condition is, we have to equate this first order derivative with 0. So it will be 320 is equals to 4q. Q will be 320 divided by 4. It will be 80 units. It will be 80 units. It will be 80 units. The maximum units which are sold is 80 units. Now we need to see that in this amount, in this number of units, our profit is maximum or not. That is, maximization exists or not. For that, what we have to do? We have to differentiate this again. Dx square upon dq square. Sorry. D square x upon dq square. Now we have to put what? We have to put the first order derivative, the equation derived from first order derivative, that is 320 minus 4q. 320 minus 4q. Again we need to differentiate this. Again we need to differentiate this. So 320 is constant, it will be 0. And 4q, 1 minus 1 will become 0. And what will remain? Minus 4. So it will be minus 4. Okay. Now see, the answer is negative. Answer is negative, that is less than 0. Answer is negative. And if the answer is negative, that means maxima exist. That means maxima exist. Right? Maxima exist. That means in this number of units, the profit will be maximum. The profit will be maximum. Also, we have to find out the maximum profit in the question. It is told that we have to find out the maximum profit. So what is the equation for profit? What is the equation for profit? This is the equation of profit. Now we have to simply put the values. 320 into 80 minus 2 into 80 square minus 12. So please solve this. Please solve this. It will be 12788 rupees. It will be 12788 rupees. I hope you understood what is happening here. What we have to do? In this question, we need to find out the maximization of profit at and x. At what number of units the profit will be maximum. So what we did? Initially, we bought the equation of profit. We solved the equation of profit. And then what we did? We differentiated the equation of profit. Please understand, we differentiated the equation of profit, not the equation of total cost, because the question was about profit, not about the cost. Okay. So what we did? We differentiated the profit. For the first time, we differentiated it and equated with 0. Okay. Whatever answer we got, then we equated that equation again. We differentiated that equation again. And when we equated the first equation with 0, we got the number of units. Then we differentiated the answer of first order derivative. Again, we differentiated it again. And then the answer was negative. And the answer, if the answer of second order derivative is negative, that means maxima exist. That means maxima exist. Is it clear to you all? So this was the concept of maxima. Now see, what we have to do in question 2. Now let's come to the question number 2. The cost function of a particular firm is given. Cost function is given, that means total cost is given. Okay. Then what we have to do, compute at which level the marginal cost attains its minimum. Now we have to find the minimization of marginal cost, and we have to find out the number of units at which the marginal cost will be minimum, and also compute the marginal cost of this level. Compute the marginal cost of this level. Now see, this question is very important. I am going to tell you one thing about marginal cost here. What equation is given for total cost? What we need to minimize? Marginal cost. Do you understand that? And what is given in the question? Total cost is given. Total cost is equals to this is the equation given for this is the question, equation for total cost. And what we need marginal cost, right? We need marginal cost. So see, there is a theory in if we have to find the marginal cost. What we need to do, we need to find out how we find out the marginal cost. What is the formula for marginal cost? Change in cost divided by change in quantity. Change in cost and change in quantity. This term itself, change in cost divided by change in quantity, itself means differentiation. Differentiation means change. Differentiation means change. Okay. So one thing also given here, what can we do? Here we don't know how much the cost is changed, and we don't know how much there is change in quantity. We have to find out the quantity, right? So what we are going to do, there is one more alternative, differentiating the cost function with respect to the quantity. Differentiating the cost function with respect to the quantity. That means differentiating, what we have to do, we have to, suppose this is C. Okay, we have to differentiate the cost function with the quantity. This will be our marginal cost. This will be our marginal cost. So we have to find out the differentiation of total cost. What is marginal cost? Differentiation of total cost. If it is given marginal revenue, then differentiation of total revenue. If it is given marginal profit, then differentiation of total profit. Okay. So what is marginal cost? Differentiation of total cost. So we have to, what we have to do, we have to find out the derivative. But this is not our first order derivative. This is not our first order derivative. Here we are finding out the equation for marginal cost, and whatever equation we will be getting, then we have to differentiate it 2 times. Then we again have to differentiate it for 2 times. But this is not the first order derivative. We are just differentiating the total cost with quantity. Okay, so what it will be? Okay, 3 minus 1, it will be 2, and here we bought the 3 here, minus, bring 2 here, 2 minus 1 will be 1, plus this will become 1 minus 1 0, x to the power 0, plus the constant, differentiation of constant will be 0. Okay, 10 will become 0. Now 3 and 3 cut, it will be x square minus 10x plus 75. This will become 1. 75, the power of 75 is 1. It will be 75 only, and 1 into 75, it will be 75. So this is the equation we are getting. for marginal cost. This is our marginal cost. This is our equation of marginal cost. Let us name it y. The name of this equation is y. Now we have to differentiate this 2 times. We have to differentiate it 2 times. We have to differentiate it 2 times. We have to start the whole procedure. Now we have only got the equation for marginal cost. This is not the first order derivative. Always remember, when it is about marginal cost, first we have to differentiate the total cost, total revenue, total profit, whatever it is. Okay, we have to differentiate it. Whatever equation we are getting, it is the equation of marginal cost. Now we have to differentiate y with respect to the quantity, the first order derivative. First order derivative. That means we have to differentiate dy upon dx. Dy upon dx. It will be one into 10 x to the power 0 plus 75. Okay. So what it will become? It will become 2x. It will become 2x minus 10 to the power x to the power 0 is 1. X to the power 0 is 1. So 10 into 1, 1 into 10, it will be 10 plus 0. So the first order derivative equation is 2x minus 10. Now what we have to do? We have to applying necessary condition, that is 2x minus 10 is equals to 0. 2x minus 10 is equals to 0. So 2x is equals to 10, x is equals to 10 divided by 2, it will be 5. So the number of units at which the marginal cost will be minimum will be this 5. But we have to find that if the minimization exists or not. Then second order derivative. Second order derivative. Second order derivative. Now what we have to do? We have to take this, the answer of first order derivative, and again we have to differentiate it. Again we need to differentiate this. It will become x to the power 1, 1 minus 1, it will be 0. Okay. And minus 10, 10 will become 0. 10 will become 0. So the answer will be 2. The answer will be 2. Answer will be 2. And if the answer is greater than 0, that means it is positive. The answer is positive. What does it means? If the answer is positive, that means minima exist. That means minima exist. That means at number of units, when the number of units will be 5, the marginal cost will be minimum. The marginal cost will be minimum. Is it clear? In the question, we also have to find out the marginal cost. We have to find the amount of marginal cost. So what we will do? Simply we will put the values in the equation. What was the equation of marginal cost? X square minus 10x plus 75. So what is the value of x? It is 5. 5 square plus 10 into 5. Sorry, this is minus. 5 square minus 10 into 5 plus 75. So it will be 25 minus 50 plus 75. The answer will be 50. Answer will be 50. The marginal cost is 50. Is it clear? This is how we do the differentiation and find out the maxima and minima. If it is about revenue and profit, maxima will exist. It should be maximization. And if it is about cost, then minimization should exist. I hope it is clear to you. I hope it is clear to you all. Now let's come to the next question. Let's come to the next question. Equation cost function is given. That means total cost is given. Our TC is 300x minus 10x square plus 1 by 3 x cube. Okay, let's solve it. TC is given. TC is given 300x minus 10x square plus 1 by 3 x cube. 1 by 3 x cube. This is our total cost. What we have to find out? Output at which marginal cost is minimum. Output at which marginal cost is minimum. We don't need to calculate the whole marginal cost, just the x. We just have to find out the x at which the marginal cost will be minimum. So what will be the formula for finding MC? Initially we need to find out the equation for MC, right? Because we need to differentiate MC. To find out the minimization of MC, we need to find out the differentiation of MC. For that we need the equation of MC. So what it is, what it will be? Let it be y. So we have to differentiate it, dy upon dx. What we need to differentiate? The total cost. We need to, this will be, we are differentiating total cost with quantity. So it will be, let it be c. Okay, so it will be dc upon dx. Now we have to differentiate it. So this will become x to the power 1 is given. So it will become 0 minus, it will become 1 plus 3 will come here and this will become x square. Okay, 3 minus 1, 2 minus 1, 1 minus 1. Okay, so this will be 300 and this will become 20x. Here 3 and 3 cut plus x square. So this will be our equation. This will be our equation for marginal cost. And then we have to differentiate this. We have to differentiate this. This is y. We need to differentiate the y function. We need to differentiate the y function with quantity. So what it will be is equals to 300 minus 20x plus x square. If we will differentiate it, it will become 0. This will become 20 plus 2x. So it will be 2x minus 20. Now what we have to do? We have to equate it with 0. So 2x is equals to 20. X will be 10. The number of units will be 10. Number of units will be 10. Okay. Now second order derivative. What we have to take? We have to take this equation. What we have equated with 0. 2x minus 20. So 20 will become 0. This will become 2. This will become 2. So the second order derivative is 2. This is positive. This is positive. Which is positive. That means minima exist. At how many number of units? At 10. At 10. So the marginal cost will be minimum at 10 number of units. So we are done with the first part. Then the second part, we have to find out the equation for average cost. Output at which the average cost will be minimum. We need to find out the output at which the average cost will be minimum. So here the equation for total cost is given. We don't know about average cost. So how to find out the average cost? It is simple. Total cost divided by quantity. And our quantity is what? Quantity here is X, right? So what we have to do? We have to take total cost 300x minus 10x square plus 1 by 3 x cube. This is the equation for total cost divided by x. Divided by x. So it will be 300 minus 10x plus 1 by 3 x square plus 1 by 3 x square, right? So this is our equation for what? Average cost. Let the average cost be y here. Let the average cost be y here. Now we have to differentiate this. dy. Differentiate with what? Differentiate with quantity. dy upon dx. We need to differentiate this. What it will become after differentiating? This 300 will become 0. 1 into 10 x to the power 0 plus this 2 will come here. It will be x. So 0 minus 10 plus 2 by 3x. 2 by 3x. Or we can say 2 by 3x minus 10 is equals to 0. This is our necessary condition. 2 by 3x minus 10 is equals to 0. So this will be, x will be 10 into 3 divided by 2. It will become 15. It will become 15. So the number of units at which average cost will be minimum. First we have to find out, does minima exist or not. So what we have to do? We have to again differentiate the equation, that is 2 by 3x minus 10. This equation. Okay. So if we are going to differentiate it, this will become 0. This is power 1. And it will become 2 by 3. It will become 2 by 3. And again, it is positive. If it is positive, that means minima exist. At what number of units? That is 15. Our x is 15 here. So this was about second part, average cost. I hope it is clear to you all. It is clearly solved in the PDF. I have solved it very roughly just to make you understand the concept of average cost as well. And then what we have to do? Output. We have to find out the output at which the marginal cost will be equal to average cost. What we need to do? We just have to equate both the equation. The equation we had for marginal cost, this one, we have to equate it with the equation of average cost. We have to equate both the equations. We have to equate both the equations. So it is very easy. You can do it by yourself. You can easily get the answer of x here. Just equate the both of the equations. Equate both of the equations. Simply here 300 and 300 will be cancelled. Now what will remain? Minus 20x plus x square is equals to minus 10x plus 1 by 3 x square. So it will be minus 20x. We can bring 10x here. This will become 1 by 3 x square minus x square. Correct? So it will be minus 10x and it will be minus 10x and this will be 1 by 3x square minus 3x square divided by 3. So this will be minus 10x and this will be minus 2x square upon 3, right? What we can do, we can take this 3 here. We can take this 3 here. It will minus 2x square. This will be minus 30x and it will become minus 2x square. What we can do now, minus 30 is equals to minus 2x square, and we can take this x here and divide. So what it will become, minus 30 is equals to minus 2x and x will be 15. X will be simply 15. So this is how we have solved the third part also. Here we don't need to do any differentiation. We just have to find out the output at which the marginal cost and average cost is equal. Output at which marginal cost and average cost is equal. So is it clear to you all? This is how we have completed our chapter number 3 also. We have completed our chapter number 3 also. Now let's start our study note 4, that is enterprise risk management. Our chapter number 4 and the last chapter of SPM, strategic performance management, that is enterprise risk management. Okay. So what this chapter is about? This chapter is about risk. This chapter is about risk in the enterprise. Risk in the enterprise. So managing that risk, managing the risk in the organization. This is enterprise risk management. Before starting, we should know that what is the meaning of risk. The first question itself is about risk. What is the meaning of risk? So what is the meaning of risk? What is the meaning of risk? The meaning of risk is chances of things not going our way. Chances of things not going our way, that we are not getting the desired results, whatever we have planned, something happening opposite to it. So this is risk. Okay, this is risk, probability of unexpected events which will bring loss to the organization, which can bring loss to the organization. So this is risk. Risk refers to the probable adverse impact of an action. Probable adverse effect, that means which is not favorable for the organization. It also means the probability. It means the probability of not obtaining the desired results. Probability of not obtaining desired results or expected outcome of an action. Whatever we have planned, we are not getting it, not getting the desired results. Things going opposite to the plan. So it has two components. Risk has two components. The first one is probability, the chances of occurring any unexpected event. The chances, what are the chances of any unexpected event which will bring loss to the organization? And the second thing is impact. What will be the impact of that unexpected event? The amount of loss it can bring. Okay. So there are basically two types of risk. The first one is systematic risk and the second one is unsystematic risk. Systematic risk and unsystematic risk. So what is the meaning of systematic risk? What is the meaning of systematic risk? Systematic risk means risk which affects the whole market. Risk which affects the whole market. And what is unsystematic risk? Unsystematic risk means those risks which affects only one organization. Those risks which affect only one organization is unsystematic risk. Okay. So systematic risk affects the market as a whole, and it is very difficult for an investor to get rid of this. and also for the companies. Okay, risk can be uh, with the point of view of investor, also with the point of view of company also. It can be from the point of view of the investor as well as company. Company also deals with the risk, and investor who is investing the money in the company, the investor also deals with the risk, right? Okay, so let's start systematic risk. It is also called non-diversified risk or market risk. Non-diversified risk or market risk. It is very difficult to get rid of this kind of risk because the whole market is affected. The whole market is affected. We cannot also do diversification. I will tell you what is diversification. I will tell you why it is called non-diversified risk. See, what is the meaning of diversification? What is the meaning of diversification? With the point of view of an investor, diversification means investing in so many companies at the same time. Investing in so many companies, in 10 to 15 companies in same time. Why? Because if one company suffers loss, he can get profit from the another company. So this is diversification with the point of view of investor. And with the point of view of the company organization, what is diversification? A company could have several business of various industries. Like Reliance is having business of clothes also, business of mobile also. So like that, investing in different industries. So if one industry is being affected, the other business is not getting affected due to it. So there will be less risk. This is how diversification works. Okay. So if the whole market is being affected, would the diversification work? No, right? Because everyone is affected. Like when COVID came, every company, every organization in the whole market was affected, right? When there is war, the whole share market is affected. In those situations, diversification won't work. So that kind of risk is known as systematic risk. That's why it is also called non-diversified risk or market risk. Is it clear? Where all the companies in the market, all the organizations in the market get affected. Okay, so types of systematic risk. Types of systematic risk. The first one is political risk. Political risk happens due to politics, due to government, and any political change in the market. Due to political changes and due to government. It occurs due to politics and government. For example, when the government changes, when there is war in the country, right? When new government comes in power, so these risk, and if it affects it, obviously it affects the market, and these risks are called political risk. These kind of risks are called political risk. Then market risk, which happens due to any economic event, which happens due to any social or economic event, like corona lockdown. Okay, like corona lockdown, declaration of new budget, announcement of budget. So these risks are market risk. Then interest rate risk. If the interest rate increases or decreases in the market, this risk is called interest rate risk. Suppose the interest rate is increased in the market. It is increased. So what investors will do? They will sell their old bonds and they will invest in the new bonds, right? So this risk is called interest rate risk. Then purchasing power risk. What is purchasing power risk? When your income is constant, but the phase is of inflation. There is inflation in the market, but your income is constant, right? Things getting expensive. Things getting expensive. Prices are increasing, but your purchasing power remains the same because your income is constant. These kind of risk is purchasing power risk. Your purchasing power declines in these cases when there is inflation, but your income is constant. Then exchange rate risk. Exchange risk. These risks are for the business which are related to foreign exchange currency, like for import business, export business, foreign transaction business, dealing with foreign transactions. So this is the risk for those kind of business. When the foreign currency rate changes, so if it is unfavorable, that means it is risky. This is currency risk. Now coming to the unsystematic risk. So unsystematic risk are those kind of risk in which only a particular enterprise, a particular organization gets affected. It could be due to any reasons. It could be due to internal issues of the management and poor management in the organization. So these risks are called unsystematic risk, and these risks can be reduced by diversification. I told you it can be reduced by diversification. If one company is not performing well, an investor can uh, get profit from another companies. And from company's point of view, when one business is not performing well, then other business can give the profit to the organization, right? So these risks are unsystematic risk. Now, what are the types of unsystematic risk? The first one is liquidity risk. When the company is not having enough cash, and the assets cannot be converted into cash immediately, these risks are called liquidity risk. And even if the company goes to sell the assets, it will be sold in loss only. These risks are liquidity risk. Then default or credit risk. When the company is not able to pay back the interest or debt, these risks are credit risk. The credit worthiness of the company gets affected. This risk are called credit risk. Then operational risk. It is due to the internal issues, the internal operations of the organization, which is not related to the market, but it is related to the internal management, like human error, machine failure. It could be anything. Poor technology, errors, fire, theft, anything. These risks are called operational risk. So is it clear to you all? The meaning of risk and the types of risk. Then the next concept is ERM, Enterprise Risk Management. The ways of managing the risk. So enterprise risk management. What is given in the question? Interpret the essence of enterprise risk management. Summarize the actual need for implementing ERM. So what is ERM and what is the need for implementation of ERM? What is ERM and need for implementation of ERM? So basically ERM is a system. ERM is a system which identifies, analyzes the kind of risk and opportunities in the market, which analyzes the kind of types of risk and opportunities in the market, and analyzes those risk and tries to reduce it and monitors all the risk. It is a system which tries to analyze the risk, monitor them, and it tries to reduce the risk in the enterprise. So it is a process which is adopted by the board. It is a process which is adopted by the management and employees also, to identify the potential threats, identify the potential risk, and also the opportunities which are available in the market, so that it won't affect the entity and won't create the loss. Risk can be managed before it comes, and it could be reduced. If it comes, it could be reduced to a acceptable level, so the organization can achieve its goals easily. This is the concept of ERM. See what is given here. ERM is defined as a process, affected by entities, board of directors, management, and other personnel applied in strategy setting and across the enterprise, designed to identify the potential events that may affect the entity and manage the risk to within acceptable limits. Managing the risk and reducing it to the acceptable levels to provide reasonable assurance regarding the achievement of entity's objectives so that the entity can achieve its goals. Okay. So now the question is, why ERM is important? ERM, enterprise risk management, is very important because today's business environment is very complex and there are so many types of risk availing in the market. So companies need a very systematic, it needs a very systematic procedure, it needs a very systematic concept for reducing the risk to the acceptable level and to identify those risks, not for one department only but for organization as a whole. It ensures systematic identification of risk and opportunities, and it brings the risk to a acceptable level and maintains the company's long-term value and growth. So this is the concept of ERM. You can read it. 2 to 3 paragraphs are given. This is the suggested answer of the institute. Read it once. And now we are coming to the need for implementation of ERM. Need for implementation of the ERM. Why implementation of ERM is important? Why it is important? See, every time the performance of organization is not same. Sometimes it is very good, sometimes it is very bad. So there could be variability in the performance of the organization. To reduce the unacceptable performance variability, ERM is important. Then align and integrate the varying views of risk management. Align and integrate the varying views of the risk management. All the different departments sees risk with their own point of view, right? They see all the departments see the risk differently. Okay, finance department sees the risk differently. They have different kind of risk. HR department see the risk differently. So all the department in the organization sees the risk differently. So ERM brings a particular point of view. It brings one point of view, the same point of view for all the departments in the organization, and it aligns everything into one particular framework. It aligns all the point of views in one particular framework so that the risk picture is clear and understandable to all the departments. So there is no confusion. It sets a particular framework for all the departments, aligns all the risk together. Then build confidence of investment community and stakeholders. It builds the confidence among the stakeholders. How? Because the investors only trust those entities, those companies which can manage their risk very well. So through ERM, risk could be managed very nicely, and the stakeholders trust can be achieved. Then enhance corporate governance. So ERM ensures that the company is working in a transparent manner. It is working in a transparent manner, that too ethically. It is reducing the risk ethically and it is accountable to the stakeholders. This enhances the corporate governance. Then successfully respond to a changing business environment. If the business environment is changing, it makes sure that the company is adaptable and the company responds to the risk very carefully so that there is no loss in the organization. And the last point is aligning strategy and corporate culture. That means the strategies and corporate culture move in the same direction. It ensures that the risk taking capacity of the company increases. It is good, that is risk appetite. And culture is also aligned to the strategy. Culture is also aligned to the strategy. For example, if a company wants to take a high risk project, then the culture should be very innovative and flexible. Culture should be very innovative and flexible. So risk management and culture should be aligned with the strategy. Okay, so this was need for implementation of ERM. once you read the concepts and then read the need for implementation of ERM. Is it clear to you all? Is it clear? Now the next question is, explain the COSO ERM framework along with the interrelated components of enterprise risk management framework advocated by Committee of Sponsoring Organization, that is COSO. See, there is a committee called Committee of Sponsoring Organizations, that is COSO. It gave a framework for ERM. So COSO gave a standard framework through which the companies implement the ERM system in a very systematic way. A company implements the ERM system. Okay, so what is the purpose? What is the purpose of this framework? The purpose is to identify and analyze. The purpose is to identify and analyze, monitor the risk, identifying and analysis of risk, monitoring the risk and responding to the risk, and using the opportunities available in the market strategically. Okay, so ERM gave a framework for implementing ERM in the organization. Sorry, COSO gave the framework to implement the ERM in the organization, the purpose of which is to identify and analyze the risk in the organization and then monitoring and responding to those risks. Okay, so according to the COSO, there are 4 ways to respond to the risk. There are 4 ways. The first one is avoidance of risk. First one is avoidance of risk. That means don't do any activity which includes risk. Don't do any of the activities which includes the risk. This is avoidance of risk. Then reduction of risk. Try to decrease the probability of risk or impact of it through giving the training to the employees, through installing the fire extinguishers. So do activities which can reduce the probability of the risk or likelihood of the occurrence of the risk or its impact. Then transfer the risk. The third one is transfer the risk. Take insurance for your assets, right? Outsource your risk by taking insurance or by having partnership with someone else so that risk could be shared. And the last one is accept. Take no action. Take no action. Like it is for small risk which don't affect the entity so much, like theft, very small thefts in the organization. So these kind of risks could be accepted. So these were the 4 ways which were suggested by the COSO to manage the risk in the organization. Now we have to write the components, the interrelated components of ERM. The COSO framework advocates 8 interrelated components of ERM. It has 8 interrelated components of ERM. What are those 8 interrelated components? What are those 8 interrelated components? The first one is internal environment. The first one is internal environment. So internal environment is about the overall culture. It is about the overall culture which decides the perspective to see the risk, how the risk will be seen internally in the organization. So it includes everything, the ethical values, management style, the environment of the organization, everything, work culture. Okay, so the first one is internal environment. Then objective setting. Objective setting. That means before managing the risk, objectives should be set. Objectives should be set. It is necessary to set the objectives, what we want to achieve, what we need to do, how to achieve the goals, right? So objectives must align with the mission. Objectives must align with the mission and risk appetite of the company. Okay, then the next one is event identification. Event identification means ERM identifies that which event will negatively affect the objectives and the organization as a whole. So those events are called risky. Then risk assessment. Risk assessment, that means evaluating the impact of the risk. Initially, probability, calculate the probability if it will occur or not, and if it occurs, that then how it will impact the organization, how it is going to impact the organization. This assessment will decide that what risks are there and how to respond to those risks. Then the next one is risk response, responding to those risks, making strategies to respond to the risk. Which strategy needs to be chosen to respond to the risk? It should be avoided, it should be accepted, it should be reduced, or it should be transferred. Then control activities. Control activities, those policies, those procedures which ensures that risk should be responded very well, risk should be responded effectively, and ERM is effectively implemented in the organization. Then information and communication. Information and communication. This is the most important thing. This is the most important thing in any organization, because communication is very important. Through communication and information, it could be identified that what risks are there in the market, and what risks are there in the market, and how to make strategies for it, how to make strategies. And everyone in the organization knows, everyone in the organization knows how to deal with it, what to do, in which direction the employees need to move. And the last one is monitoring the risk. Last one is monitoring the risk. Company regularly monitors the risk. Company regularly monitors the risk so that the response is effective, so that it can effectively respond. Then what are the different ways of managing risk? Different ways of managing the risk. Now, what are the different ways of managing the risk? Different ways of managing the risk. So there are 6 ways. There are 6 ways. Here one is missing, that is risk indicators. Risk indicators. And here in explanation, risk indicators is given, but the Rune theory is missing. But I will tell you what is Rune theory. Okay, I will tell you that also. So how the risk could be managed? How the risk could be managed? So there are 6 ways. There are 6 ways. The first one is risk pooling. The first way is risk pooling. Risk pooling. That means making a pool. That means making a pool or group of insurance companies. Making a group of insurance companies, that means making a pool in which all the insurance companies contribute if some loss occurs. Okay, if some disaster happens, all the insurance companies contributes, and company doesn't handles it alone. Company doesn't handles it alone. One insurance company doesn't handles it alone. So this is risk pooling. Then diversification. I have already told you that what is diversification. What is diversification? Company invest in different business. Company invest in different sectors, different business. So if there is loss in one business, there could be profit in the another business. Okay. Then risk analysis. The third one is Ruen theory. The third one is Ruen theory. So basically, what is Ruen theory? It is applicable to the insurance companies. Ruen theory ensures that the company is not becoming bankrupt. That means the company is not going into loss. The capital doesn't become zero and it doesn't become negative. Okay. For it, what it does, it sees the initial capital of the insurance companies. Then what the premium is being received by the insurance companies. Then is the insurance company paying claim, a very huge claim, to any insured. Okay, so these things are studied and what capital is available to the insurance companies. So it ensures that the insurance company never goes bankrupt. Okay, the capital never becomes zero or negative. This is ruin theory. It doesn't ruins itself. Then the next one is risk analysis. The next one is risk analysis. That means identifying threats. Identifying threats, analyzing the risk, calculating the amount of loss it could create, and reducing it to the acceptable level. Reducing it to the acceptable level or completely eliminating it. This is risk analysis. Then next one is risk mapping. So risk mapping is a visual tool. Risk mapping is a visual tool in which a company puts risk into a matrix. It puts the risk into a matrix. A graph is being made. In the horizontal axis, probability is given, and in the vertical axis impact is given. Okay, so it is a visual tool. Then risk indicators. The last one is risk indicators. It's just like an alarm to the company. Risk indicators are just like the alarm to the company. It gives signals in advance. It gives signals in advance that some risk is going to happen in future. These are the indicators of risk. For example, if the customers' complaints are increasing day by day, if the complaints are increasing day by day, that means there is quality risk, right? That there is risk in quality. If the inventory level is very high, that means there is financial risk. There is liquidity risk also. So these are the different ways to manage risk. Different ways of managing risk. Different ways of managing risk. Now the next question is about explain the risk management and objectives of it. Describe how risk is reduced through diversification in the context of enterprise risk management. So what is risk management? What is the meaning of risk management? So it is a process of measuring. It is the process of measuring or assessing the risk and developing strategies to manage the risk. Analyzing the risk, measuring the amount of risk, the impact of risk, and then making strategies accordingly. So basically it is identifying, analyzing, controlling areas or events with the potential for causing unwanted change, and then trying to manage the risk to bring it to the acceptable level, reduce the risk to the acceptable level, or completely elimination of risk. So risk management basically has the following objectives. Risk management has the following objectives. The first one is anticipating the uncertainty. That means what could go wrong. Anticipating the uncertainty, what could go wrong. Then channelizing events to happen the way they are planned. Channelizing the events, that means ensuring that each and every event is on time. Channelizing the events. Each and every event is on time. And controlling through meeting the deadlines, monitoring, etc. Controlling those events by meeting the deadlines and controlling, monitoring, etc. Then setting right at the earliest opportunity deviations from plans whenever they occur. If anything seems wrong, then immediately correcting it so that it would not increase, the risk would not increase. Then the fourth one is achieving objectives, ensuring that the objectives of the planned event is achieved by alternative means when the means chosen proves wrong. If one thing goes wrong, if one alternative goes wrong, then finding the other alternatives to achieve the objectives. In case the expected event is frustrated, making the damage minimal. If the whole event fails, then trying to minimize the damage. If everything is failed, again trying to minimize the damage. For example, if the inventory becomes obsolete, then try to sell it in discount. Try to sell it in discount. That means minimizing the damage. Then what we have to tell in this answer? Risk reduction through diversification. Already I have told you what is diversification. You can read it, you will understand. Okay, you will understand. We have already discussed the diversification. Next question is, explain the qualitative and quantitative methods of risk analysis. Qualitative and quantitative methods of risk analysis. What is risk analysis? Identifying the threats, measuring the impact, and finding the ways to reduce it. Right? We have already studied what is risk analysis. Now, what are the methods of risk analysis? So, there are three types of methods. The first one is qualitative methods. Qualitative methods, that means when the risk is very low. Risk is very low and simple analysis is needed. Detailed analysis is not required. Simple analysis is required, but detailed one is not required. When the risk is very low, the probability is also very low. Okay, so what are the qualitative methods? The first one is brainstorming. What is the meaning of brainstorming? That means listing all the possible risk. Brainstorming means listing all the possible risk. Then questionnaire and structured interviews. That means asking questions from important persons in the organization. Right? Then evaluation from multidisciplinary groups. In this, all the departments, the different groups, finance group, production group, HR group, everyone sits together and all give their perspective. Each and every group gives their perspective. Then judgment of specialists and experts. That means taking feedback from experts. This is qualitative method. Then semi-qualitative method. What are semi-qualitative methods? That means dividing the risk into high, low or medium category based on the probability and impact. Okay, based on the probability and impact. Then watching that which one is the most critical, which one is moderate and which one is low. Then quantitative methods. In quantitative methods, everything is measured in detailed, calculated, simulated using mathematics, probability and statistics. It is a very detailed study of risk. So quantitative methods encompasses analysis of likelihood. That means what is the probability. Then analysis of consequences. That means what will be the impact. And the last one is computer simulation, in which the different scenarios are made. To see the worst case, the best case, and which is the most likely one. Okay. So these were the three methods of risk analysis. The next question is, describe the risk mapping. Explain the importance of risk mapping. What is risk mapping? We have already discussed what is risk mapping, right? We have already discussed risk mapping. It's a visual tool. In the horizontal axis, probability is being given, and in the vertical axis, what is given? Impact is given. So the risk for which the probability is high and the impact is also high, those risks are critical. Risk with high probability and high impact will be the most critical one. Then risk with low probability but high impact, those risks are moderate. And risk with low probability and low impact also, those risks are low risk, right? So this is how we have to identify the risk on the basis of risk mapping. Now, what are the benefits? Of risk mapping? It allows the organization to identify, understand the risk environment and assess the frequencies and severities with which the risk occurs. It helps to understand that which risks are more frequent, which risks are more probable, and which are not. What will be the impact? High impact or low impact, right? Then promotes awareness of significant risk through priority ranking. which risks are to be prioritized, which risks are critical and needs immediate solution. Okay, then enables the delivery of solution and services across the entire risk management value chain. Through using this risk map or diagrams, a company can know which risks are urgent and which needs urgent solution, which risks are to be prioritized, which risk could be accepted, needs no action. Then aids the development of an action plan for effective management of significant risk. That means development of a action plan after identifying the critical risk, moderate risk and low risk. Then assigning clear responsibilities to the individuals. Again, when we know that which risks are critical, which risks are low, which risks are moderate, accordingly we can give responsibility to the individuals in the enterprise so that they can manage. Then provides an opportunity to leverage risk management as a competitive advantage. If we are able to mitigate the risk, if we are able to handle the risk, so we can achieve the competitive advantage over the competitors. If we are accurately studying the risk, we can achieve the competitive advantage. It will result in better stability and better reputation in the market so that we can gain the competitive advantage. Then the last one is facilitates the development of strategic approach to insurance program design. That means it helps in deciding that which assets needs insurance and which assets don't, how much cover is needed for each asset, and insurance policies are designed in a better way. So I hope risk mapping is also clear to you. I hope risk mapping is also clear to you. Now the next topic is corporate risk management. Next topic is corporate risk management. So in this concept, the first question is about REPM, risk enabled performance management. Risk enabled performance management, REPM. Explain briefly the REPM, risk enabled performance management. Summarize the focus areas of traditional ERM and also classify the areas of practice based on which transformation to REPM is done. See, here we need to tell about the concept of REPM. We need to write about the concept of REPM. What is REPM? And what is the traditional concept of ERM? ERM is a traditional concept and REPM it is a advanced version. It is a modern concept. So we have to first give the concept of REPM, then we have to give the focus areas of the traditional approach as well as the modern approach, that is REPM. So first of all, what is REPM? What is risk enabled performance management? What is risk enabled performance management? So risk enabled performance management is a modern approach of ERM only. It is a advanced version of ERM. So it is a system in which the company focuses on the performance goals. The company is focusing on the performance goals, but it considers the risk which may occur in that process. It considers all the risk while making the strategies, right? It considers all the risk and the probability and the impact of the risk that can occur in the future. That means when it sets the goals, when the company is setting the goals, at that time only it considers the possibilities of risk, and when it measures the performance, it sees that what will be the influence of the risk on the performance. This is REPM. This is the model of REPM. REPM is equals to performance management plus risk management. Performance management plus risk management. What is REPM? Performance management plus risk management. That is considering the risk while making strategies, while evaluating performance, considering the influence of risk. What could go wrong and making strategies accordingly. Now, what are the focus areas of traditional ERM approach? The focus areas of traditional ERM approach. The first one is C. Independent enterprise risk identification and assessment process. The first point is saying that in ERM, traditional ERM approach, risk is identified separately from operations and strategy. There is no relationship, there is no integration of strategy and risk. Risks are not considered while making strategies. Okay. Then risk reporting to top management is one of the primary aspect. Risks are reported to the top level management and there is no action. They just have to, risk is just to be reported to the top level management. Then the risk management process is independent of operations and performance management. Again, risk management is not related. In this concept, risk management is not influencing, neither it is influencing nor it is connected with the operations and performance. Then historical perspective design the evaluation of current exposure. That means in old ERM, mostly the decisions are taken on the basis of the history or past decisions. But it is not like that in the modern concept of REPM. The focus is on compliance. The focus is only on compliance, on complying the rules, on compliance of regulations and avoiding the risk. Avoiding the risk. So there is no value creation and improvement in the performance of the organization. Is it clear to you all? This was about the traditional ERM model. Traditional ERM model. Then the transformation to REPM is based on some leading practices which are grouped in three aspects. Now the ERM model is transformed. It is transformed into REPM. Now it is modern concept and it is grouped into three aspects. It is grouped into three aspects. The first one is REPM is used to measure and drive the performance. It is used and to measure and drive the performance. The first point is integrates the risk and performance management. So REPM integrates the risk and performance. That is, while setting the goals, risk is considered. The factors of risk are considered. The factors of risk are included. Then creates linkage between the KRIs and performance drivers. So REPM basically connects the KRIs, that is key risk factors, key risk indicators, and KPIs, key performance indicators. So it creates a link between KRIs and KPIs. Then used data analytics for risk analysis. It uses data analytics. Data is stored, data is analyzed for risk analysis. It is done on the basis of data which is collected. Then second point is REPM is forward looking. It is forward looking. That means it defines future trends and undertakes predictive analysis. So the important part of REPM is predictive analysis. That is, no past data is involved, but decisions are taken for future. Future possibilities are seen and analyzed and plans are made accordingly. Future opportunities are also seen and plans are made accordingly. Then emerging risks are also considered. It also considered the new risk which could emerge, which were not there in the past and not in the present also, but they could emerge. Then scenario analysis and stress testing. Scenario analysis and stress testing. That means so many scenarios are made. So many scenarios are made and strategies are accordingly made, so that there is reduction in risk in the future if something occurs. And what is stress testing? What is stress testing? That how the company will sustain in the extreme conditions. This is stress testing. Testing it previously before something happens, so that how the company will react in the stressful situations in future. Then action and result oriented. So REPM is action and result oriented. While making strategies, making decisions, and in daily operations also, risk factor is properly considered. It is action and result oriented. Action and result oriented. Now let's come to the next concept. So this concept is not so important. So I'm just giving you the overview of risk retention. What is risk retention? It simply means accepting the risk. It simply means accepting the risk. That means if the loss occurs, the company is going to bear it. The company is going to bear it. No transfer, no insurance, nothing. So why the company is doing it? Why the company is doing like that? Some risk cannot be predicted. Some risk cannot be predicted, and so that the strategies cannot be made for it, like change in customer behavior, change in market conditions, we cannot analyze it previously, right? So how can we make the strategies for it? So these risks are accepted. Sometimes the companies undertake risk itself, like introducing new product to the market. So it may fail also, right? But it has to take the risk, because higher the risk, higher the profit. This is the concept. These are the reasons for which the company performs the risk retention. It accepts the risk. Sometimes the risks are also very small, so there is no point in taking insurance. If we are taking insurance and all, it will bring more loss to the organization instead of accepting it, right? Sometimes probability is very low. Probability is very low. Then sometimes what happens, the business exactly knows the nature of the risk. The business exactly knows the nature of risk, when it could occur, how it could occur, and what will be the impact. The impact can also be calculated. So the business is prepared. The business is prepared and ready to face and retain it. Okay, like for example, seasonal demand fall. Seasonal demand fall, late payment by customers. So the company, what can the company do? It can make the reserves and funds for it, but it cannot make a proper strategy. So this is risk retention. This is risk retention. Now the next concept is, what is value at risk? What are the advantages and limitations? Again, this topic is not so important, so I am giving you the overview. What is value at risk? What is VAR, or value at risk? VAR, or value at risk, means maximum potential loss in the portfolio. Maximum potential loss that may occur in the portfolio, which can happen due to the risk in a given period of time. In a given period of time and in a given probability level. What can be the maximum potential loss in the portfolio that may occur due to the risk? Okay. So there are so many types of VAR. Long-term VAR, marginal VAR, factor VAR, stock VAR. Okay, shock VAR. So these are the kinds of VAR. Again, I am telling you, this topic is not so important, but I have given it to you in PDF, so please read it once. What are the advantages? What are the advantages of VAR? First one is, it is easily understandable. That means it just gives a number. It just gives a number which tells the maximum loss in the portfolio. It is easily understandable. Applicability. It compares different risk easily. It compares different risk easily. So it can be applied in different kinds of assets. It can be applied into different kinds of assets like shares, bonds, commodities, futures, forex, etc. Then acceptability. Acceptability. It is widely acceptable. Widely acceptable by the companies, by the investors, by the banks, everyone. Then used for performance evaluation. Used for performance evaluation. Instead of showing the instead of showing the returns, it shows the risk adjusted returns. Instead of showing the returns directly, it shows the risk adjusted returns. So the performance can be evaluated. Performance can be evaluated. It is very useful for performance evaluation. Now, limitations. The first limitation is, it is dependent on the inputs and assumptions. It takes so many assumptions. It takes so many assumptions because the results are compared on the basis of what? Past data, assumptions, and market consequences. So it takes so many assumptions. Then sometimes it gives inconsistent results. sometimes it is misleading, and sometimes it is very difficult to calculate. So these are the limitations of WAR, value at risk. Now the most important topic with practical point of view, corporate failure. This is the most important topic in which there are three models. Two models are covered. The first one is NCAER and the second one is Z-score model. There is one more model, that is M-score model, which is not given in the PDF. You have to study it by your own. It is rarely asked in your exam. It is rarely asked in your exam, and it is so complicated to cover it in marathon session. So that two models are only given here. The third one is M-score. You have to do it by your own. It cannot be covered in less period of time. Okay. But once go through it. So what are the models to predict the corporate failure? The first one is NCAER, Nation of Council of Applied Economic Research model. What this model says, according to this model, an industrial undertaking may be financially viable if the three elements are proved to be positive. It is only profitable. An entity is only financially good and profitable only when the three aspects are positive. What are the three aspects? What are the three elements? Cash profit position. Profit, that means cash profit only. After adding all the non-cash expenses which we have deducted to come to the profit. Then net working capital, current assets minus current liabilities. Then net worth position, share capital plus reserves and surplus. These three things should be positive. All the three elements should be positive. And even if the one element is negative, that means the firm has the tendency to become sick. It could become sick. And if any of two elements are negative, when two elements are negative, that means it is incipient sickness. That means it could be sick. It is on the way to become sick. And if all the three elements are negative, that means it is fully sick. So let's come to the question. You will understand what it is saying. See, balance sheet is given. In one side, liabilities is given and assets are also given. Liabilities and assets are given. Depreciation, non-cash expense. Preliminary expense, non-cash. These are given. Okay. So now there are three elements we have to find. The first one is cash profit. How we are going to figure out the cash profit? The company is having a net loss. Instead of profit, already it is having loss. So take 25.60, add non-cash expenses, then just a second, add non-cash expenses and then add preliminary expenses. So it will be minus 16. It is negative, right? It is negative. Then net working capital, current assets minus current liabilities. Current assets 57.60 minus current liabilities 78.40. Again it will be negative. Then net worth position, share capital plus reserves and surplus. This is our share capital, and instead of profit giving in liability side, it has given in asset side. That means it is a loss. It is not a profit, it is loss. So we have a negative balance of profit and loss account. So 20.80, this is our share capital, minus 40. This is our negative balance of P&L account. So again it will be negative. So all the three elements are negative here. That means the organization is fully sick. This is the sign of corporate sickness. It is fully sick. It is in the stage of being fully sick. Immediate, necessary, drastic revival measures are essentially required for the survival of the company. Measures are to be taken. Drastic steps are to be taken to save the company, to make the company survive. Now the next model is Z-score model. Z-score model. It is also called Altman Z-score model. It was given by Altman. It was given by Altman. Okay. So in this model, what we need to do? In this model, what we need to do? We have to find out a Z-score. We have to find out a Z-score to tell that whether the firm is a distressed firm or not, or it is a normal one. Okay, so there is a formula. There is a formula for Z-score. How we have to find out the Z-score? This is the formula: 1.2x1 plus 1.4 x2 plus 3.3 x3 plus 0.6 x4 plus 0.999 x5. Now what is this x1, x2, x3, x4, x5? What is this? These are different ratios. These are different ratios which we have to calculate by using the data given in the question. So x1 is working capital to total assets. X1 is working capital to total assets. Then x2 is retained earnings to total assets. Then EBIT to total assets. X4 is market value of equity to book value of total debt. Market value of equity to book value of total debt. Then X5, sales to total assets. Sales to total assets. Now what we have to do? We have to find out all the 5 ratios. We have to find out all the 5 ratios and then multiplied by x1 is multiplied by 1.2, x2 is multiplied by 1.4, x3 is multiplied by 3.3, x4 is multiplied by 0.6 and x5 is multiplied by 0.999. Okay, so this is how we have to calculate. See, one question is given. Using the Altman of corporate distress prediction, calculate the Z-score of S and Company Limited, which is having 5 accounting ratios are given below. See, ratio is already given in the question. Ratio is already given in the question. So what you have to do? You just have to multiply. You just have to multiply. X1 is given. This is X1. This is X2. This is X3. This is X4. This is X5. Everything is given in the question, and we know what is the formula. We know what is the formula. This is our formula, right? We just need to multiply. That is 1.2 into 25%, or you can also write 0.25. 0.25 plus what? 1.4 into 0.30 plus 0.6 into 0.15 plus sorry, 3.3 into 0.15. 3.3 into 0.15 plus 0.6. 0.6 into 1.50 plus 0.999 into 2. So the answer will be 4.115. The answer will be 4.115. Answer will be 4.115. So what we need to do now? See, here the criteria is given. If the Z-score is greater than 2.99, that means the firm is non-failed or non-distressed firm. The firm is non-failed or non-distressed firm. It is financially safe and healthy. Okay. Then if the Z score is less than 1.81. If the Z score is less than 1.81, that means it's a failed or distressed firm. It's a failed or distressed firm. And if it is higher than 1.81 but it is lesser than 2.99, that means further investigation is required to determine the solvency status. It is in gray zone now. It is called to be in gray zone. Now the company is on alert. The company is on alert because it is lesser than 2.99, right? It is on alert and it is in gray zone. Further investigation is required to determine the Z score, to determine the solvency status. Okay, so this is how we have to find out the Z score. Here our Z score is greater than 2.99. It is greater than 2.99. So the firm is financially safe and healthy. It is a non-bankrupt company. It is a non-bankrupt company. It is financially safe and healthy. Now there is one more model you have to study it also. Don't leave it. So our today's marathon session is over. We have discussed all the 4 chapters, all the important topics of all the 4 chapters. Now you have to perform really very well in your examination. I hope now you are feeling very confident and now you know the paper pattern, the weightage of each and every chapter. Okay, so please perform well in your exams. Best of luck.